network of societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
Hi everyone, good morning. My name is Gloria Etetem. I work with CFA Society Nigeria. Welcome to day 2 of our May 2025 Level 1 revision CFA revision bootcamp. So we are going to go straight to the point. The first session for today is ethical and professional standards, which will be taken by Adiola Badebo. She's a CFA charter holder and a member of CFA Society Nigeria, who has graciously volunteered to take this session for the next 1 hour. She has also confirmed that she will be sharing her slides. So please, at the end of today's session, we'll send an email with a link to fill the feedback survey to access the available slides that we have from our facilitators from yesterday and the ones for today. So please, you have the floor, Adiola. Going to go on mute now, but we'll be on throughout. So if you need anything, please just let us know. And please, for the candidates, if you have any questions to interact with the facilitator so we can make good use of the 1 hour, please use the chat room to drop your questions so that she can attend to them on the go. Thank you.
Thank you, Gloria. Thank you. Good morning, everyone. Afternoon, rather. Please confirm you can hear me and you can see my screen.
Yes, I can hear you. I can see your screen. I'm sure others can confirm in the chat.
Excellent. So I think we can dive right in. So welcome to this session. We'll start straight up. We're going to be reviewing ethics, which is short form for ethical and professional standards. My outline will go through some preamble, then we'll discuss ethics and trust in investment profession. We'll move on to code of ethics, then the standards of professional conduct, and then we discuss some guidance for standards 1 to 7, and we do a bit of introduction into the global investment performance standards, which we fondly call GIBS. And then we will look at some questions. As a starting point, I think I want to emphasize that ethics is very, very important, and that it's critical for you to actually take it seriously right from your level 1. And why is that important? I know if you've looked at the weights of the different segments of the exams that you'll be writing, ethics is actually one of the highest in level 1. It's going to range between 15 to 20%. So it's very critical. And interestingly, let's say you are at borderline. That means maybe the minimum passing score has been determined, and maybe your score is closer to it. There's something that CFA calls ethics adjustment. So let's say you could have missed the minimum passing score otherwise, but if you've done very well in ethics, there will be an adjustment that will favor you into allowing you, pass that exam. So that's why ethics is very important. Also, it is consistent throughout the CFA levels 1 to 3, while the level 1 has almost the highest weight because it ranges between 15% to 20%. For level 2 and level 3, the weight will be between 10 to 15%, which is still a significant, weight of your exams. Also, I like to emphasize something that when you start reading and practicing the ethics, it's important to know that you need to pay attention to the questions, because there are 3 key traps that make people actually miss the questions, even though they know the answer, and that can be more painful. They will make general statements. Often when you see general statements, which you will see when we look at some of the sample questions, you need to watch out for your answers. And sometimes the question is phrased as, which one is the most likely answer or the least likely? Sometimes you know the answer, but maybe your eyes, you just read it as, oh, the answer is supposed to be positive, like what was the most likely? Whereas the question is the least likely. So that you need to pay attention to. I also want to emphasize that for ethics, you need to actually read the curriculum, and then you need to note, and this other information actually applies to all the other subjects as well. You need to pay attention to the end of curriculum summaries, because they are crucial to reinforcing what you've learned. So you would notice, it's structured in readings. Almost all the readings have a summary at the end of each reading. In fact, I suggest that when you want to start a reading, you can read the summary first, because it tells you the key things that you need to take away from that reading, and it helps you reinforce it. And as you do that as well, you need to do the end of curriculum practice questions, and then of course the online question banks. So I must reiterate, as you're reading, you need to practice those questions, both the ones that they're using the physical book, and also the extra additional question bank that is on the website as well, or on your learning ecosystem is very, very important. Also, I've attached 2 links for the documents. Let me just show that a bit. So if you look at this 2 links, which you would see when she sends you the slides, it actually has like a summary 1-pager, for ethics, where it talks about the code of ethics and the 7 standards. So it's a good way to have it to be able to revise. Then the second one is something around ethical decision-making framework. So that as well is also important to help you, learn and reiterate what you're learning. So I think we can go right into it. I hope you're still with me. So we want to go straight to the conversation. So we start ethics. I'm sure ethics is something that we're familiar with. What do we think ethics mean? I mean, you can just drop a chart and then we can have that conversation. Because when you say someone is ethical, what comes to your mind? Or we say something is, oh, that's not ethical, or that's someone that behaves in an ethical manner. What comes to your mind? Okay, I can see someone wants us to share the links in the chat. I'll do that. So what comes to your mind when we talk about ethics generally? Any takers? All right, I can see people typing in integrity, morality, excellent. That's exactly what it's about. So ethics actually is about, encompasses a set of moral principles. It's like rule of conduct that provide guidance for behavior. And the origin of ethics is from the Greek word ethos, and it means character, something that guides your belief or your ideals. And typically that's what holds societies and groups and even nations together. So moral principles, often also called ethical principles, are beliefs regarding what is good, what is acceptable, and what is obligatory behavior. And in the same vein, it establishes what is bad, unacceptable, and forbidden. So it's all about, the beliefs that guide your behavior. And of course, if you say you have a society like CFA society, it's the same thing. It means you have a set of principles that guide what is acceptable within that society. And that is what people often then write down and call a code of ethics. So you see a lot of professions actually have a code of ethics. You see that in investment management, like in the CFA society, even in some other society like the medical field, so it's an important thing. So while code of ethics is a general guide for how members in that community should act and behave, some of the societies actually go ahead to then codify these ethics into like standards of conduct, where they actually set benchmark for what is minimally acceptable behavior within that community. So what the standard does is that it expresses what the code of ethics stands for better, like putting it as into guide as to, the do's and don'ts. So that's what the standards of conduct actually serve as. And when you look at it, you say a profession is like a community, like an occupational community, that has a lot of things binding the members together, such as specific education. If it's medical profession, you know that they are medical practitioners. If they're in the financial industry, you know that finance experts and practitioners. So they have like specific education, expert knowledge, and a behavior that actually underpins trust, respect, and recognition in that community. And for professionals, it is obligatory for them to actually keep the standards, but not just the standards, which is why we're saying that it's all about ethics. It's what is morally right or wrong. You will see as we delve into it, we will still clarify that difference, when it comes to ethical behavior. Is it that ethics and legal behavior are the same? Are they different? We will get into that shortly. Just to reinforce, like I said, as you read any part of the ethics or any of your subjects, it's always important to test your knowledge along the way. So I'm going to read these 4 questions, and I want you to just drop your answers, in the chat. I'd love to do a poll. However, I'm a bit mindful of our time. So I'll just ask us to drop the options before I display the answers. So the first one says, which of the following statements is most accurate? You would remember that I've said that you have to watch these questions. It says most accurate. Sometimes it can be the opposite, which you will see. So it says, which of the following statement is most accurate? Ethics can be described as A, a commitment to upholding the law. B, an individual's personal opinion about right or wrong. C, a set of moral principles that provide guidance for our behavior. So let me see your answers in the chat. If you can, excellent. I can see majority of us have that nailed down. It is a set of moral principles that provide guidance for our behavior. So let's go to 2. Which of the following statements is most accurate? A, standard of conduct are a necessary component of any code of ethics. That's A. B, serves as a general guide regarding proper conduct by members of a group. C, serve as benchmark for the minimally acceptable behavior required of members of a group. Excellent. I can see the answers coming in. It's actually C. It serves as the minimally acceptable behavior required of members of a group. I think it's very critical to know that it's minimally. And why I said, you remember I said you need to pay attention to how the questions are phrased. Some option might have read, serves as a benchmark for maximally acceptable behavior. Because it's minimally, you might have just clicked it, not reading that change. So it's important to actually know the questions and the answers that you're selecting. So it serves as benchmark for the minimally acceptable behavior. So number 3 now, let's do that. Which of the following statements is most accurate? A profession's code of ethics, A, includes standards of conduct or specific benchmarks for behavior. B, ensures that all members of the profession will act ethically at all times. C, publicly communicates the shared principles and expected behaviors of a profession's members. Excellent. I can see the answers coming in. It is C. They have a code of conduct that does not and expected behaviors of a profession's members. And a shared code of ethics best characterized, I think I skipped E there, it should be ethics. A vocation. B, a profession. C, an occupation. Excellent. I can see Ada responding correctly. It's a profession. So we've already taken through the answers. So let's just go on. So now let's look at what ethics is all about when we talk about legal behavior. So it says, of course, in any nation or society, laws and regulation try to codify ethical actions that would ensure that the outcomes are good for the society. So you see that typically most legal rules and regulations are born out of ethical standard or moral principles, which is why we say that legal and ethical behavior often coincide. However, you should note they do not always, because sometimes some things will be ethical and it will be in due course of time before they then make laws around that. So it's important to note that while legal and ethical behavior can be the same, ethical behavior goes beyond what is required by the law. So standards of conduct based on ethical principles may actually represent a higher standard of behavior than the behavior that is required by law. An example is when we talk about insider trading. In some countries, it's not illegal for people to actually have, an information distinction is important. That distinction is important. So the ability to relate an ethical decision-making framework of any firm to the code and ethics, it allows everyone to be able to bring that principle to life. And something is important that is reiterated through the curriculum, which is that developing and maintaining and demonstrating strong culture of integrity within a firm by senior management is actually the single most important factor in promoting ethical behavior among the employees. So you might see this in some questions, that it is important for senior management of companies to model ethical behavior. So given the importance of ethical behavior in carrying out our professional responsibilities, the CFA has designed like an ethical decision-making framework that helps us make better decisions that are in the interest of the society. So it's one of the links that they dropped for me, in the chat that you can refer to later. So the framework is all about first you identify the facts of the particular case or situation, all the stakeholders, which are the people that will be impacted, to whom you owe a duty, of course, the ethical principles that apply to that situation, and conflicts of interest. Then the next step is that you have to actually consider the things that can impact your behavior that determines whether you then act, in an ethical manner or not. Those are situational influences, additional guidance, and alternative actions. Then, of course, when you've evaluated this, then you decide and you act. And after you've made a decision, you have to reflect, subsequently to know, was that the anticipated outcome? If that was it, why and why is it not so? Maybe I can give an example. Maybe you attempted, to cut corners, maybe to take a bribe. If you're looking at the identifying relevant facts, you look at, if you do that, it undermines the integrity of the whole system. You look at the people that can be hurt by that decision. And then when you look at situational influences, that could be like, everybody's doing it, why not me? And then those are the things you consider before taking a decision. So we're going to look at another set of quizzes. And I want to reiterate that I put these quizzes there because I believe that it will help you reinforce what you're learning and it will show you how the exam is typically set. So you would see a lot of it in the course, of the presentation. Just understand, what we're trying to use it for. So it says, how does ethical conduct most likely compare? A, ethical conduct goes beyond what is legally required. B, there are no differences between the two, they are the same. C, doing what is legally required removes the need for ethical standards. Excellent. I've seen your answers, and that is correct. Ethical conduct goes beyond what is legally required. So it says, which of the following statement is most accurate? It's still the same thing, but asking it in a different way. So it says, which is what you will see in a lot of the questions, is to actually show that you know exactly what you're standard. So let me go to the third question and fourth question, and then we'll review everything together. Exactly. We have discussed it. I can see your answers coming in. We have just explained that not all legal behavior is ethical, whereas some ethical behavior may actually be illegal. So that is B. So challenges to ethical conduct. Which of the following will most likely determine whether an individual behave unethically? 1, a person's character. 2, the person's internal traits and intrinsic motivation. 3, such as environment or cultural elements. Excellent. External factors, such as environment and cultural elements. So people can be tempted following best identifies an internal trait that may lead to poor ethical decision making. A, overconfidence, loyalty to employer, promise of money and prestige. Exactly, is overconfidence. Some people feel, oh, I'm an ethical person, I cannot do something that is not ethical. And because of that, they don't actually consider all the factors they need to consider and how to behave. And this overconfidence then trips them. Correct. So let's look at this set of questions before we then go further into our discussions today. So it says to maintain trust, investment management profession must be interdependent with A, regulators, B, employers, C, investment firms. Yes, Amaka, that is correct. It is C, is with investment firms. Typically, regulators provide oversight, and then the regulators actually, would I say, checkmates and provide the rules by
Hi everyone. I think her internet just disconnected, so she's going to join back. Please give it a few seconds. She's joining back. She's back on, and we'll be continuing now. Hi, Ajaba.
Apologies. Yeah, I think I had a slight fluctuation in my network and I saw that it threw me out. Please accept
Yes.
my apologies. I think we'll just proceed. Please confirm you can see my screen.
Yes. Yeah, it's coming up.
Okay.
I can
Thank you.
see the screen.
Apologies. Okay,
That's
so we'll
fine.
just continue from there. I think I'll just go through the answers to this one so we can make up for some of the lost time. So, of course, the second one says, we had read the question, situational influences actually can motivate individuals to act in short-term self-interest. So this actually is the correct answer. 3, we say which of the following statement is most accurate? Increased regulations are most useful means to reduce unethical behavior by market participants. No. So we've said that typically that can change and that can impact people. But the answer here is a new laws designed to reduce or eliminate conduct that adversely affect the market can create opportunities for different but similarly problematic conduct. So this is just saying that you cannot actually make every aspect of ethical behavior all about being legal. So you need to rely on those morally right principles to guide behavior. I think before we go to the next one, I want to emphasize the last one because that typically comes up in some form or the other. So it says when there's an ethical dilemma or when an ethical dilemma occurs, an investment professional should most likely first raise the issue with mentor outside the firm, professional bodies outline, senior individual in the firm. Always note, the best practice is to actually start from your organization, whether it's your compliance or your supervisor or a senior individual before you start exploring outside legal counsel, mentor, or escalating the issue. I think that is very important to reiterate. All right, so let's switch gears and discuss the components of code of ethics for the CFA society. So I'll just go through the highlights of the 6 of them. It's important you know this to understand them. So it says that members of CFA Institute, which include CFA charter holders and yourselves, candidates for the CFA designation, members and candidates must act with integrity, competence, diligence, and respect, and in an ethical manner with the public, clients, prospective clients, employers, employees, colleagues in the investment profession, and other participants in the global capital markets. Component 2, it says members and candidates must place the integrity of the investment profession and the interest of clients above their own personal interests. So for this one, the ranking is the investment profession, the interest of clients before you start considering your own interest. So 3, it says that members and candidates must use reasonable care and exercise independent professional judgments when conducting investment analysis, making investment recommendations, taking investment actions, and engaging in other professional activities. The way to remember this is that the latter part is just talking about what you would typically do as an investment professional. It's saying you need to use reasonable care and then you exercise independent professional judgment. That means nothing is forcing you to make that decision. No one is coloring your judgment, not bribe, not anything, and you're using reasonable care. Next one says, members and candidates must practice and encourage others to practice in a professional and ethical manner that will reflect credit on themselves and on the profession. Keyword here is you practice and you encourage others to practice in a professional and ethical manner. The next one is also very interesting and important. It says, members and candidates must promote the integrity and viability of the global capital markets for the ultimate benefit of the society. Very, very key. Then this last one says that members and candidates must maintain and improve their professional competence and strive to maintain and improve the competence of other investment professionals. You will see when we get into the standards. I mean, it's so important that one of the standards was amended to reflect this professional competence, because as investment professionals, we need to be competent in what we do. So they introduced a sub-standard that actually expatiates on this. So, okay, I think this part too is very, very important. I'll just quickly go through it. So it says, for all institute members and candidates enrolled in the CFA program, we're all required to comply with the code and standards. Then now, so this one is important as well. It says the CFA Institute Board of Governors, they maintain oversight and responsibility for the Professional Conduct Program, in short PCP, which in conjunction with the Disciplinary Review Committee is responsible for enforcement of the code and standards. But you need to learn here, sometimes there can be questions around that if you look at some of the practice questions. So it says, whenever you say anything that has to do with Board of Governors, you just know that the responsibility of Board of Governors is typically to maintain an oversight and responsibility for whatever it is that is being discussed. So I'll go on to talk about the institute bylaws and rules for professional conduct. So this here we'll talk about how they deal with maintaining and ensuring that people are actually abiding by the rules and the code of conduct. So you have the rules for procedure for professional conduct, which forms the basic structure by which they actually enforce the code and standards. So of course, there are people that actually manage this, which is why as a full member, you have to actually declare yourself, declare that, you are in compliance with the code and ethics. But how would they typically know when people are in violation of this? So first, from what members and candidates self-report, sometimes from the media, sometimes people actually also write them and bring this to their, attention. So it's important to note that when a case is referred to them and they investigate it, of course, there are different things that can come out as a result of their findings. Sometimes they could investigate and the person is, not found culpable, and then, of course, no disciplinary sanction is applied. But sometimes they can issue a cautionary letter, or sometimes they can actually say, oh, this requires, further proceedings to know what to do to the member of candidates. So when that happens, the candidate or member that is being accused of that violation can actually decide to accept or reject whatever charges and the proposed sanctions. When they do that, however, that is the matter is then referred to a panel that is composed of the Disciplinary Review Committee. And then that panel will then be tasked with actually determining whether the person has actually violated the code and standards, and if not, what should be done. So, of course, the significant consequence that can happen when you violate anyone, you could be publicly censured. There could be suspension of your membership or use of CFA designation. There can be a revocation of the CFA charter. And for you that are candidates, it's also important to follow instructions. Don't cheat in the exam, or when they say time up, it's time up, because sometimes that's where some candidates actually run foul of the code and standards. So let's look at some questions here. I'll just read the question and answer so that we can gain some time. When you see the material, of course, you can, try and answer them in your own time. So you say, which of the following statement best describes an aspect of the professional conduct program process? A, inquiries are not initiated in response to information provided by the media. That is false. We already talked about that. Investigation results in disciplinary review committee panels for each case. No. We had said that when the candidate or member who they brought the case against actually rejects the decision, the initial decision by the DRC, then they will then refer that case to the review panel. So C is the correct answers. It says investigations may include requesting a written explanation from the member or candidates. Of course, we've talked about this next one. It says, which of the following group is most likely responsible for maintaining oversight and responsibility for the professional conduct program? It's the CFA Institute Board of Governors. And we've talked about the type of sanctions that can happen. So I think I want to take the fourth question just to show us what, typically can, be asked. So it says, current code of ethics principle reads in full, promote the integrity of A, and viability of the global capital markets. B, of and uphold the rules governing capital markets. C, and viability of the global capital markets for the ultimate benefit of the society. So you can see that the first one, the A option, actually had some elements of the answer. So if you had just stopped at A and you didn't read through the options, you would have missed our questions, which is why I say you have to pay attention to the questions and the options that you're reading. So C is the correct answers. All right, so let's switch gears a little bit and move into the standards. So for the standards, we actually have, for the standards of professional conduct, we have 7 standards. Of course, within the standards are substandards, but I will quickly go through these 7 standards and then we can dive a little deeper into them one after the other. So the first one is professionalism, very important. The second one is integrity of capital markets. Third is duty to clients. And of course, once you say duty to clients, just know what follows duty to clients is duties to employers. And then 5 is investment analysis, recommendations, and action. And 6 is conflict of interest. The conflict of interest has some changes to it recently. We would emphasize that it used to be disclosure of conflicts of interest prior to now, but it's changed to conflict of interest, and we will show why. And of course, the last one is responsibilities as a CFA Institute member or a CFA candidate, just like. So let's go straight into professionalism. So the professionalism standard 1A standard 1 actually has 5 substandards. It used to be 4 substandards. I'd mentioned that competence is so critical now that it was added in 2023 revisions. So I will just give you an idea of what to focus on in each of these standard and substandard and what it entails to guide your reading and understanding. So here he's talking about professionalism, which is the core of any society. If you have a society that has to do with a professional body, you need to be professional in what you do. Professionalism has to be demonstrated. And how is professionalism demonstrated? That is in 5 substandards, which is discussed under standard 1. So 1A is knowledge of the law. Just know here, it means that you must understand and comply with all applicable laws. I mean, whatever you're doing, any law that pertains to what you're doing, you must understand and comply. Keyword is understand and comply. Now, under the same knowledge of the law, it says, the standard says, in the event of conflict, you must comply with the more strict law. So this 1A actually has like 4 elements that is important. The first one says you must understand and comply with all applicable laws. The next one says if there's a conflict, you must comply with the more strict law. And I'll give an example. And in the next slide, you will see the examples, come alive and how you would apply that. So it's saying that, let's say the law, maybe your company law says, oh, keep record for, I'm just using an example, keep record for maybe 4 years. Maybe the government says keep it for at least 3 years. You keep to the one that is more strict. So that is that element. Always remember, more strict law. Now, it then goes on to say you must not knowingly participate or assist in any, things that breaks the law. And then it says you must dissociate from any violation of such law, rules, or regulation. So that is knowledge of the law. Where you obey all laws, where there's a conflict, you keep the more strict one, and you dissociate from anything that has to do with violation of the law. So the standard 1B is about independence and objectivity. So if you want to be a professional, you say the mark of professionalism is that you do the right thing, which means nobody is influencing what you're doing, unduly. And that's why the standard says that members of candidate must use reasonable care and judgment to achieve and maintain independence and objectivity. That is the core. you want to achieve and maintain your independence and your objectivity. And typically what would impact this? That has to do with things around gifts, compensation, and that is why it then says you must not offer, solicit, or accept any gift, benefit, or compensation or consideration that reasonably could be expected to compromise your own or another person's independence and objectivity. So when it comes to independence and objectivity, you're saying nobody's influencing you. And typically, how do people try to influence? Is through gift, through different things, which is why the standard goes deep into things around not offering, not soliciting gifts that could impair your independence and objectivity. The next one is misrepresentation. That's standard 1C. So it's saying you must not knowingly make any misrepresentations rather, related to investment analysis, recommendation, action, or other professional activities. So it's saying in anything you are doing, you cannot make any misrepresentation. Misrepresentation in a layman's word is lie, or you try to quote, is lie any way you look at it, whether you are, being dodgy about it or knowingly saying what you know is not true. So once is about misrepresentation. Now, 1D, this is a bit different. This is about misconduct. So it's saying that you must not engage in any professional conduct that involves dishonesty, fraud, deceit, or commit any act that reflects adversely on your professional reputation, integrity, or competence. So here is about how you behave, even outside of, work. Is it that are you stealing? Are you involved in credit card fraud? Anything that you can look at misconduct, anything that you can interpret as you say something that would embarrass you or your family, that's misconduct. And then the standard 1E, which is the latest addition to standard 1, is about competence. So here it's saying that members and candidates must act with and maintain the competence necessary to fulfill their professional responsibilities. So here it's saying that you have responsibility. You must be competent to be able to do that. And we'll talk about competence, which is, I'm sure, one of the reasons why a lot of you are taking the CFA exams. You want to improve your competence. That's why you're doing this. So competence is important. That's always, learning and knowing all aspects of your profession. So this table is very important. And this is just showing how this knowledge of the law is applied, when it comes to that part that we discussed, which is that where there is a conflict, you must always select the law that is actually stricter. So let's give an example here. I will take maybe one or two. I'll just give you like an insight into what you have to do. So you need to first assume that in any situation, let's say maybe you have a less strict law, more strict law, and then you have the code and standards. Always know that as a minimum, what you can use is the code and standards, because we believe that the code and standard is robust. However, where a rule actually is stricter than what the code and standard provides, then you must adhere to the more strict law. You will never see any case where we encourage anyone to actually go for the less strict law. No. Rather than the less strict law, you will defer to the code and standards. So let's look at maybe 2 or 3. So it says, let's assume that a member resides in a country which is no strict law. Oh, I think this is what they meant to put, no strict law, yeah. I think they meant to put no strict country rather, does business in a less strict country. So say the person is in a place where there's no law, but he does business where the law is actually less strict. So of course, it's where he's doing business. They said the LS law apply, which is the low strict one. So in this case, because what applies is the low strict law, as I explained, you cannot pick the low strict law. So you must adhere to the code and standards. So you can see the explanation there. Because the applicable law is less strict than the code and standards, you must adhere to the code and standards. Now, so let's look at the second one. So it said you reside in a no-strict country, but however, you do business in more strict country, and the more strict country applied. So long as it's stricter, you must pick the stricter, law. So here it says you must adhere to the more strict law country. That's what you would do. Exactly. So it says, because the applicable law is stricter than the code and standards, you must adhere to that code and standards. So that's the different examples I've tried to put in there. In the curriculum as well, you will see it. So whatever it is, however they place it, the first thing you need to check is which law applies. So when they say the law, this particular country applies, you check the law in that country. Is it less strict? Is it more strict? If it's more strict, then the candidate must adhere to the more strict law. But if it's less strict, you would never choose less strict. You would then defer to the code and standards. So that's just the shortcut around that one. So let's look at 2 questions and then we'll move on. I think we have done that first one. So let's look at this. We've already said it that when there's an ethical dilemma, the person you should refer to should be someone senior in your firm. So this says that according to the standards, a member who is asked to produce an issuer-paid research report is required to A, avoid cash compensation, B, disclose the nature of the compensation in the report, C, decline to write the report if the member's firm provide investment banking services. No. So here it's saying that, we had said that standard is about maintaining your independence and then objectivity. So if you are being paid to do the report, you declare it to people that are going to consume the report. So once they see that you say that you are being paid, they will be able to judge what it is that you are saying for themselves. So that's why it's important. So this independence and objectivity is very, very key. So I'll read the next 2 so that we can see what it's typically about. So this one says, which of the following is a recommended procedure for compliance with standard related to independence and objectivity? So members should encourage their firms to prohibit employee participation in equity-related IPOs. Of course not. Even an employee can invest, which is probably why they're in the industry. Anyway, B says, remove a corporate client's company from the research universe and put it on a restricted list if the firm is unwilling to disseminate adverse opinion about the company. C, provide every client with the procedures and policies for reporting potentially unethical behavior, violation, regulation, or other activities that may harm the firm's reputation. No, B is the correct answer. So here it's saying that, let's say, you cannot, if someone is your customer, if you were to do a research, the research means you have concerns about maybe some of their performance, and that might be seen differently. You can decide to put it on a restricted list, which means, because of the relationship with this client, you would rather not, make a statement as to whether I recommend people to invest in a company or not. So this is like best practice. Now, this other part is also important because when you're talking about that standard 1, you remember we talked about knowledge of the law, independence and objectivity. Independence and objectivity always has to do with gift. So it says, according to the standard related to independence and objectivity, a gift from a client could be considered supplementary compensation. B, compensation arrangement should link analyst remunerations to investment banking assignments. C, portfolio managers may report sell-side analysts to cover companies if analyst changes in recommendation adversely affects client portfolios. So it's actually A. So if the client is giving you a gift, that's already a supplementary compensation. You will see what you should do with those ones in other laws. I will skip this one so that, let me take the third one. I think it's important. So I'll take the second one rather, so you can get an idea of when they talk about independence and objectivity. So it says, Dilshan Kumar, CFA, is a world-renowned mining analyst based in London. Recently, he received an invitation from Cerberus Mining, a London Stock Exchange-listed company with headquarters in Johannesburg, South Africa. Cerberus asked Kumar to join a group of prominent analysts from around the world on a tour of their mines in South Africa, some of which are in remote locations, not easily accessible. The invitation also includes an arranged wildlife safari to Kruger National Park for the analysts. Kumar accepted the invitation planning to visit other mining companies he covers in Namibia and Botswana after the safari. To prevent violating any CFA Institute standard of professional conduct, it is most appropriate for Kumar to only accept which type of pay travel agreement from Cerberus. Answers: grant transmissions to Kruger National Park, B, economic class round trip ticket from London to Johannesburg. C, flights on a private airplane to the remote mining sites in South Africa. Now, I'll explain why this is about it. Let me read this answer so that you can get a sense of how we think about this. So it says that he just wants to use reasonable care and judgment to maintain your independence. So in this case, the only reason they're saying it's okay for him to accept the private airplane is that they say that it's not easily accessible, which is why he's doing that. Let's say it is easily accessible. Best practice would be for him to pay for his own trip by himself, because you don't want anything that can impair his judgment. So that's what they're saying. It's because it's unlikely that there's a commercial flight, then he can actually go with them on the private flight. However, he cannot join them to the national park on their bill. He would have to pay for that, because that's the only way he can maintain his independence and objectivity. So let's look at integrity of capital markets. I think I have to accelerate a bit because our time is almost fast spent. So here he's talking about integrity of the capital market. This one has two substandard. The first one is material non-public information. Here he's saying that you should not, trade profit or from how do I put it, from something that is not already in the public domain. So it says when you possess material non-public information that can affect the value of an investment, you must not act or cause others to act on it. And when we say material, what is material? That's something that can affect the price, or that can affect the price of the investment. For instance, if you know that, the company is going to declare more profit than they've ever declared, that's material. If you know the company maybe Google is about to acquire a smaller company, that information is material. So things that are material is key. Now, when you say it's not public, it means it's not yet in the public domain. Maybe just few people know about it. It's not yet public. So you wouldn't trade in that. That would be a violation of that standard. However, there's an exception to this rule, which is the mosaic theory. The mosaic theory says that you may actually use all information that is in public domain. Let's say the information is public, but by going through the information, you then realize that, maybe this company has said that Google has bought this company already. But then maybe on your own, you discover that, this company's review, the customers' review of this company's product has totally gone up, increasingly, maybe because of a new version that they deployed. And that information is coming from your own analysis of what is already in the public space or what is not material. Then you can trade on that. That is mosaic theory. The standard 2B actually says market manipulation. Here is saying that you should not engage in any practice that would distort price or artificially inflate trading volume. So here, just know that there are two typical ways people try to manipulate the market. Either is information-based, you spread lies about the company, or is transaction-based, you keep trying to do different transactions to mislead participants. So that is not something to do. So you see, dissemination of false or misleading information, that's market manipulation. Then transaction that deceive market participants or destroy the price setting mechanism. Maybe the shares is not really liquid, but you start doing so many transactions. You buy, then you go and sell at the other end to make people think that it's actually liquid. That is a violation of that standard. So let's go to the next standard right now. I'll leave some of these questions and answers because you can see them either on the slides, in the presentation slides, or in the curriculum. But just as I've reiterated, it's very important that as you're studying, you go through those questions because that's how you reinforce it and that's how you can learn things that can easily trip you up. So the standard 3 is talking about duties to clients. So here, the first one is saying that loyalty, prudence, and care, that you owe a duty of loyalty to your clients, and you must act with reasonable care and exercise prudent judgment, and you must act for the benefit of the client. Place the client's interest before your employers or before your own. Just note here is about that responsibility. And then the question then is, who is the client? That's actually the first thing you need to know here. Who do you owe that duty to? For instance, let's say you're managing pension fund. Of course, you have the pension fund administrators. The pension fund administrators are not your client. The clients are the ultimate, holders or beneficiaries of that pension. So that's the people you owe that duty to. So the other one is about fair dealing. So it's saying that you should deal fairly and objectively. However, this is not talking about maybe customers are subscribing to different type of different class of product. That's different. For that one, all of them, you should treat them, the same, depending on the class that they are in. And then that one is just showing that whatever it is that you're doing, it should be public to them enough to know, oh, let's say maybe you are a premium subscriber, this is what is available to you. If you're a regular subscriber, this is what's available to you. But you treat people in the same bracket, equally. Another part that is very key is actually, so it's saying that you need to make a reasonable inquiry into a client's investment experience, risk and return objective, financial constraint prior to making an investment recommendation. Think about this one this way. I can't come to you and say, oh, tell me, should I invest in the GCB shares, treasury bills, Access Bank shares, or FG federal government bonds? And I just say, oh, invest in FG bonds. I don't even know your experience. I don't know your situation. I don't know, your risk tolerance. No, before you can even determine suitability, you need to at least know that person to an extent. So that's what suitability is about. And then when it comes to portfolio, you can never look at, suitability, as just one-off. You have to consider it in the context of the customer's existing portfolio. So that's important. Of course, the next one is performance presentation, which goes without saying that when you're making or communicating anything, it needs to be fair, accurate, and complete. You must let people know what you're saying in plain language. Then, of course, it goes without saying that you have to preserve confidentiality. That is very key. So this is just trying to highlight it. I've already spoken about it. You need to know who your client is. And of course, you must always look at it in the context of client portfolio. There's something is important here. Those conversation around soft commission policies. Soft commission is for the client, which anything you're doing should benefit the client, not that you use the client soft commission for something personal. So I'll go to the next standard. I think I'm really running out of time. I don't know if I can ask for maybe an extra 5 minutes or 10 because of that downtime to be able to just cover some more. Gloria, I don't know if you can accommodate that, or maybe I'll just be rounding up now. Gloria, can you hear me?
Hi, Adela. Yes, did you say 5 minutes?
Yes, just so that I can run through the other standards, but of course
Okay,
they
no
can
problem.
read the others, just so
Okay, no
that
problem.
I
I'll
don't
inform the next
time.
facilitator.
All right, thank you. And apologies, I didn't
Yeah.
expect that fluctuation in the network.
No, it's
So
fine.
this
It
one,
wasn't
duties
your
to,
fault. Yeah.
okay, thank you. So duties to employers, just like we said, that one is around your employer loyalty. Things around additional compensation and responsibility of supervisors. So loyalty just means that you must act for the benefits of your employer. You should not deprive your employer of your skills, your abilities, and then you should not divulge confidential information. And this loyalty, you see it when you start some of the examples and case studies, is around how you maintain the interest of your employer. And even if you're planning to leave the organization, like whatever work that you've done in that organization belongs to the organization. You can't take it when you're leaving without, their consent. So that's what that standard covers. The other one talks about additional compensation. We had said that just say when we did, you shouldn't take bribe that would impair what you're doing to your client. This one is like you should not accept gift or benefit or compensation that might then compete with the interest of your employer. You can imagine maybe you're in a particular, maybe your employer is a bank, then you started your own personal business at the same time, competing with the same organization. So those are the things that additional compensation covers. The responsibility of supervisors. Here is saying that when you have people that you supervise, you also have a responsibility to ensure that the people that you supervise comply with applicable law, regulation, code, and standards. Where you feel that the system is not set up in a way that you can achieve this, then you decline that particular role. So that's what that covers. Of course, we've talked about this, leaving an employer, the things that you can do, do's and don'ts. So I'll go to the next one, which is actually, I want to emphasize this because of one thing that they added as well. So here you have 3 standards. The first one is diligence and reasonable basis. So standard 5 is about investment analysis, recommendation, and actions. So how you actually do what you do, how you evaluate opportunities, and how you make your advice and recommendation. So 1, there must always be diligence and reasonable basis. That's standard 5A. Must exercise diligence, independence, thoroughness. There must be a reasonable, thoughtful basis, and that is supported by research, which goes without saying. B, communication with clients and prospective clients. So they added one new one recently to the standard, which is what I've attached. So it says you must disclose to clients and prospective clients the nature of the services you are providing, along with information about cost to the client. Not only will you tell the customers the services you are providing, you must say the cost as well, declare the cost. So of course, the other one talks about, you declaring the basic format or general principle of your investment process, how you analyze your investment. You must also tell them the risk and limitation, risk and reward. They must know what it is that is there. And you must know what is important to the analysis so that you can declare to your customer. And of course, record retention. You must keep appropriate record of whatever it is that you're doing and your analysis. And this part is important. It says where there is no guidance as to how long you should keep records, CFA recommends at least 7 years. So let's look at this. This is another one that they amended. This and then the last one before we close. So this, they amended, it used to be disclosure of conflicts of interest, but it's been changed to conflicts of interest with keyword avoid or disclose. So before now, they used to just say disclosure. There was nothing to talk about avoid. But now they're saying you should avoid or make full and fair disclosure of matters that could be relatively expected to impair your judgment. So things like people could construe as conflict of interest, it should be declared and it should be prominent in plain language. You have to say that publicly. Then, of course, priority of transaction. We have said this, that the client transactions, the clients first, the society first, then the client, and then the employer before yourself. So it's saying here that transaction for clients and employers must have priority over investment transactions in which a member or candidate is a beneficial owner. Of course, the next one is referral fees. That when you're referring something, you must disclose to your employer, clients, and everyone any compensation or additional benefits you receive by recommending a product or service. You must declare that. And of course, this one is the last one that is interesting and applies to yourselves as well. So this actually speaks to your conduct as a participant in CFA Institute programs. You should not engage in any conduct that will compromise the reputation or integrity of society. Very important. Things around cheating in exams, talking about parts that were tested in exams, is prohibited. And of course, the last one is how you refer to CFA Institute and your designation and CFA program. There is the right way and the wrong way to do it. I'll just give 2 examples and then I guess I can call it a day. I won't be able to cover GIPS, but I'll just say 2 things which you can then, delve into when you're reading on your own. So things here is just saying, you cannot say, oh, I have CFA level 2, nothing like that. If you're registered for the exam, you're a level 2 CFA candidate. And you cannot say, oh, because you're a CFA charter, that means all your results will be better than people that are non-charter or not correct. So you can look at some of those designations to guide you. I'll just say 2 things so that I can quickly hand over about the GIPS. That's Global Investment Standard. Just so that things around this is how people present performance reports in a standard way that people can understand. I'll mention these 3 key things and then I'll leave you to just read the rest. So here it says that GIPS standards are a practitioner-driven set of ethical principles that establish a standardized industry-wide approach for investment firms to follow in calculating and presenting historical investment results to prospective clients. And the key thing is that it ensures fair presentation and full disclosure remember that fair representation and full disclosure of investment performance. And who can claim compliance? Only firms that manage actual assets can claim compliance with GIBS standards. Consultants cannot. So neither can software companies. Only customers or companies rather that manage actual asset can claim compliance. And also note, compliance is firm-wide process. I cannot say this unit is in compliance or that unit is not in compliance. If you are not in compliance firm-wide, then you are not in compliance. So I'll reiterate these two things. You either fully comply with all requirements of GIBS standard and claim compliance through the use of GIBS compliance statement, or you do not comply with all requirements of GIBS standard and then you cannot claim compliance. That is the key thing. One last thing before I go, and then we can take it up from here. So it says that when you're considering GIBS standard, the firm should adopt the broadest, most meaningful definition of firm. Always remember that it's the broadest, most meaningful definition. And then, of course, your definition of discretion as to how you judge your portfolio, it should be done from the beginning, not that, oh, it's after the fact that you don't be making those changes. And notice this other part, it says non-discretionary portfolio must not be included in any of the composites. Just know that only discretionary can be included in any of the composites. But if it's non-discretionary, you cannot put that. I think that's it. That's my extra 5 minutes. So we can just read some of those questions. Okay, we're already there. Some of those questions I've highlighted. But in conclusion, I would encourage you to read, the end of curriculum summary, read the curriculum, and as you're reading each of the reading, practice the questions, practice again, review the summary, practice again. And then one other key thing, closer to because ethics can be nuanced sometimes, just so that you can reinforce it and then be able to answer the question. And remember to note the question, whether they're saying most likely, least likely, so that you are answering the correct question. And I wish you the very best in your exams. Thank you. Thank you, everyone, for your patience. And then, Gloria, I think I can add over to you.
Yes, thank you very much, Adiola. We are really, really grateful for spending your 1 hour on a Sunday with us today. So the next topic, the next class will be quantitative methods, to be facilitated by Olabode Williams. He's a CFA charter holder and a member of our society who has volunteered to take this course. It's going to run from 1 p.m. From now till 3 p.m. basically around 2 hours. So please, Olabode, I've made you a co-host, so you should be able to share your screen and unmute yourself. And again, please, we are unable to extend the classes because this has already been planned. What we'll do is that in the email you will receive after the session, at the end of the day, you find a link to a playlist that contains different session recordings for these ethics classes and other classes as well. And we'll also share some clips. That we have some video clips for ethics and other resources. We'll just share so you can study on your own. Williams, please, you have the floor. Okay.
Hi, Adiola. Can you hear me?
Yes, Gloria, I can hear you.
Okay.
Yes.
All right. Could you just give me a moment?
All
I just
right.
got on the other system where I have the presentation. I'm just waiting for it to
Are
reconnect.
you Williams? Is that your system as well?
Yes,
The
I'm William.
Williams. Okay. Do you want me to make it a co-host so you can just, in case you want to do anything on that system?
Yes,
Yes.
please.
Okay, I've done that now.
Can you also enable I'm unable to unmute.
So I've made the two accounts co-hosts. You should be able to share on either devices. Then I think the one you're not speaking with, you should disconnect audio to avoid that echo.
All right. Okay. Let me just share my screen. Just a moment.
Okay.
Can you confirm if you can see me?
Yes, I see your screen, but it's not yet on full screen.
Is it on full screen now?
No, it's not on full screen.
Let me reshare. Please. What about now?
It's not on full screen, but I guess we can just go ahead. Hopefully the following slides will be visible as this. Yeah.
Oh, I'm not sure why it's not. Okay. Um, Let me just try one more time. So it's on full screen here. I'm not sure why it's not. Okay, so let me just make it bigger, perhaps. What about now?
It is now. Thank you.
All
Yes,
right,
it is. Yeah.
thank you. Good
All right.
afternoon, everyone, and thank you for the opportunity to share with you, just take you through some part of the curriculum where to a large extent will be important for you as you prepare for the final run to your exams. I'll be doing a revision on quantitative methods. Quantitative methods, really, from a CFA point of view, is that curriculum that enables you to learn the different tools and methodologies for quantification. As an investment analyst, you use a lot of numbers. There are input into whatever analysis that you're doing. But how do we arrive at those numbers? Either returns, variance, and all of that for whatever measurement you want to do. You will need numbers. How do you arrive at those numbers? So quantitative methods takes you through this a scientific way of arriving at a number. And typically when you tell say your colleagues in the office, for example, that I think inflation will be 15% next year, they're going to ask you on what basis. If you tell them, oh, I just feel this to be 15%, nobody's going to take you seriously. But if you can show them that you ran the numbers and, they could see that that you follow the scientific process of arriving at that 15%, you're likely to be taken seriously. Now, a lot of the numbers that we use as analysts, a lot of those numbers, either those ones that are made available publicly or the ones that we do generate internally in our offices and spaces, we come up with them through all of these quantitative methods. So as you go along in level 2, level 3, you're going to see a lot of QM method and tools, but perhaps in a much more rigorous way. For level 1, it's a mix of both calculations and concept, really. And for the purpose of this revision, if we go into a lot of calculations, we might not really have time to cover a lot. But I'm going to take you through as much as possible those concepts that they typically ask or might be asked, or you might come across in your exam, that is asking you about that is testing your understanding of those concepts of relationships. And I think those will be important as you go into your exam. So most likely you see questions, that perhaps they might even have numbers, but you might not really need to do any calculation because you understand the relationship and the process of those of that particular number. I'll start by looking at measures of central tendencies and location. And just to state that, typically we talk about mean, median, mode. Now, mean, median, mode, they are part of measure of location. So central tendency just tells you that they're in the middle. So mean, median, mode, their location is in the middle. But there are other locations, across your observation. So measure of central tendency is a subset of measure of location, right? And so for measure of central tendency, we look at the mean. I have intentionally just left the curriculum that talks about arithmetic mean and all of that, geometric mean and all of that. I think they are the easy parts for QM. And for the purpose of this revision, I won't be focusing more on it. And again, because a lot of that you will also see in the other parts of the curriculum that I would cover. But for arithmetic mean, what you need to be very familiar with going into an exam are these properties. Arithmetic mean is sensitive to extreme values, and you could be asked in a number of ways to test your understanding. It could be in a statement, it could be a statement, and you'll be asked to say, "Oh, is it true or not?" So just know that arithmetic mean is sensitive to extreme values, or what we call outliers. And the reason for that is because observations are used to compute the mean and are given equal weight. So the reason why arithmetic mean is that sensitive to outliers is because in arithmetic mean, all of the observations are given equal weight. Until later when you see weighted averages, and for now, in calculating mean, you just simply assume that all observations have the same weight. And because of that, a small observation will have the same weight as a big observation. which means that you're likely to see is very skewed. Arithmetic mean can be put sharply upward or downward by extreme large or small observation, which is still linked to the first point I've made. So if you have a set of observation and then you have one very large observation, it can, drag it either up or down. And then the most common approach is to report the median. So when you have a mean that is not, perhaps because of an outliers, that is not so reliable, the common approach practically is for you to look at other measures of central tendencies. For example, your median or your mode, because what mean really measure is central location, right? And that's the same thing that the median measure. That's the same thing that the mode also tries to measure. When we're looking at median, you want to bear in mind that to calculate median, you could either be given a set of odd numbered observation or even numbered observation. How to calculate mean from that, it's important. So if you're faced with an odd numbered observation, the formula for the median is n plus 1 divided by 2. I put it there so that you can see it and also remember. And also, if it's even number, then you will have two figures, the n divided by 2 and n plus 2 divided by 2. But here's what you need to take into consideration when working with median. A distribution only has one median, right? Unlike the mode where you have unimodal, bimodal, trimodal, which means you can have more than one mode. For median, you can only have one median for your distribution. Outliers do not affect median. So even if you have outliers, unlike your mean, outliers do not affect median. And so if you're given a question, for example, where you're considering between a mean and a median, you want to check if there is any discussion about outliers in that question. If there are outliers. If there are outliers, what that is trying to tell you is to look at the strength of the median over the mean, and therefore perhaps you should be looking at the median in that kind of scenario. The median does not use all of the information about the size of the observation, and that is the reason why it's not affected by outliers. It does not use all of the information. Contrast that to mean that uses all of the information, and so it focuses only on the relative position of the ranked observation, relative position. And also calculating the median may also be more complex. And as you can see, for example, if you have even number, you already see two formulas there that you need to remember. So calculating median can be complex, and these are the disadvantages and the advantages that you need to be familiar with when you're answering questions on median. Working with frequency distribution, so typically you can get something like this. How do you explain it, or how do you use it, or how do you use it to answer questions? It's important that you understand how this particular table, because you can use this table to answer a number of questions on frequency distribution. The absolute frequency simply just talks to the number of observation within the bin, right? For example, within the bin minus 4.0 to minus 3, there are 7 observations there. The relative frequency takes that 7 over the total observation. So when you add the 1 plus 7 plus 23 plus 77 up onto the last one, and then you then take that 7 over that total number, that is your relative frequency, right? Your absolute frequency and your relative frequency will be the same. So for example, the largest absolute frequency is 555, which is the largest absolute. You also see that the relative frequency is also the largest for that being, which is 44.12. So your highest absolute frequency will always give you your highest relative frequency, right? Then what about cumulative relative frequency, right? Cumulative frequency add up all of the observation up onto the point where you are. So for example, the cumulative frequency up onto being minus 2.0 to minus 1.0 is 8.5. And what that has done is that it has added all of the frequency up onto that point. Now, the highest cumulative frequency would always occur in the last bin with at least one observation. So when you look at the cumulative relative frequency, the very last column, for example, you will find out that the highest number there is 100, which happens in the last bin of 4 to 5. The reason why you have that is because there is an observation in that bin. For example, if you do not have an observation in that bin, let's say it's zero, the observation in that bin is zero, you will have reached 100 in the bin before that. That is, you will reach 100% in the bin 3.0 to 4.0. So you will get 100 there. The next bin will still be 100 because nothing is added to the cumulative frequency. So your highest cumulative frequency would always occur in the last bin with at least an observation. And that is so important for you to be able to understand that. How do you deal with outliers? We've talked about how outliers affect the mean, for example. How do you deal with it? As per the curriculum, there are three options discussed. Of course, clearly there are other options, but as per your curriculum, these are the ones discussed. You can decide to do nothing, which means you can just use the data without any adjustment. And it's possible that you look at the data and realize that, oh, perhaps you did make an error. Maybe that's what the data says. Or sometimes you look at the data and realize that, oh, there's actually an error here, so I need to make some adjustments. So the first option is that you do nothing and you just run your data like that. Of course, bearing in mind the challenges or the weaknesses of having an outlier in your observation. The second option is for you to delete the outliers. So you could look at the outliers. Say I have 10 observations, 1, 2, 3, 4, 5, 6, 7, 8, 9, then 1,000. That 1,000 is clearly out of the league of 1 to 9. And there is no way I run any mean on that would not be skewed. For example, if I run a mean of that, I'm going to get 990 something. 90% of my data is not represented in that mean, right? So I'm likely to be wrong, or that mean is likely to not be meaningful or useful. So what I can do is that I can delete that outlier. So I can just decide to delete that 1,000 and then use my 1 to 9. But a way to do that scientifically, rather than just make up my mind to say I want to take out 1,000, right, is to trim the mean. By trimming the mean, it means I'll just cut off some. I can decide to cut off the last number and the first number. So in that case, I can cut off 1 and cut off 1,000 and then call it a trimmed mean. That way, I'm saying I have applied the scientific approach rather than just saying, oh, I don't like 1,000, I delete it. Someone can ask me, why did you delete 1,000? Yes, it's an outlier, but it's not like it is wrong. But if you use a trim mean method, you then have a scientific explanation to say, no, I simply deleted the highest number and the lowest number. That way, there's a scientific explanation to it. The third option is for you to replace the outlier with another value, right? And that is called the winsorized mean. So for example, with my observation of 1 to 10, I can then decide to say, from 9 upwards, I'm going to change whatever is there to 10. And then from 2 downwards, I'm going to change from whatever is there to 2. That way, I will then have 2, 2, 3, 4, 5, 6, 7, 8, 9, 9, for example, if I decide to change the last number to 9, right? So I will not have 1 and I will not have 1,000, but I would have replaced the 1 with 2 and I would have replaced the 1,000 with 9. That is called winsorized mean. And that is the difference between the trimmed mean and winsorized mean. In a trimmed mean, you simply let go of those numbers. That is, you delete those numbers. But for winsorized mean, you do not. You simply replace them with another number. And because this is a scientific approach, you typically do that on both ends. If you're trimming, you trim on both ends. If you're winsorizing, you winsorize on both ends. And that's how to deal with outliers. There are other measures of location. Like I mentioned earlier, we talked about measures of central tendencies. I didn't talk about mode because mode is, clearly quite simple. It is the highest occurring, observation of frequency. And you could have more than one mode, which means you could have unimodal, which is one mode. You could have bimodal, which is 2 modes, or trimodal, which is 3 modes, or you could even have more than that, right? But that's simple enough. For other measures of tendencies, we can split our observation into different compartments or location. We could split it into quartiles. Quartiles split the observation into quarters, which means you split them into 25%, right? Or into 4 places. So when you split it into quarter, the way you split the year, even though the year has 12 months, you split it into quarter and it ends up being three months. Yes, right? So any number you have, you split it into 4. If you split 100 into 4, you have 25, 25. If you split 1,000 into 4, you have 250, 250 that way. And that's called quartiles. And so it means you will have 4 bins or 4 places if you split into quartiles. If you split into quintals, you are splitting it into fifths. And then it means that you're using 20%. That's what it means. And it means at the end of the day, you will have 5 bins, right? If you split into deciles, you're splitting into tenths, which means you're grouping into 10, 10. At the end of the day, you're going to have 10, like 10 bins. If you split into percentiles, you're splitting into 100. That is, you're splitting into 1, 1. So you will have 1%, 7%, 10% because it's 1, 1. But if you are doing deciles, you will have 10, 20, 30, 40 that way. If you're splitting into quintals, you have 20, 40, 60, 80, and 100. If you're splitting into quarters, you will have 25, 50, 75, and all. And that's what I've tried to represent in the, in the table by the right, where you see that decile we have 10, 20, 30, and then we have quintals, 20, 40, and all of that. Now, there is something called the interquartile range or the IQR. The interquartile range uses quartiles, and it is the difference between the third quartile and the first quartile. When you're given a table like the one on the right, and you need to calculate your interquartile range, what you need to do is to look at the upper bound. Always work with the upper bound because the upper bound takes the upper bound and everything below it. And so that is the best measure to take. So whatever bin you're taking or whatever cumulative percentage sample you're going with, you go with the upper bin. Always use the upper bound. Always use the upper bound for your calculation. For example, in this table, if we're to calculate the IQR for this table, we will take 0.460, which is the upper bound of Q3, and then we will deduct the upper bound of Q1, which is 0.2933. And that's how the IQR will be calculated. And so just to understand how that is done. Then it's also important for us to understand other measures of location like box and whisker. Box and whisker, typically when it's set up in an exam format, it could come in any format you get, but what you need to be able to do is be able to interpret the box and whisker. Now, in box and whisker, it might come with information, and when it comes in with information, the test might just be that you are able to pick the right information for your calculation. For example, if you're given a box and whisker like the one on the right, you can calculate your IQR from there. That is your interquartile range. How do you know where your interquartile range is? The top bound of the green color is always your Q3. That is your Q3, your third quarter, and the lower band is always your Q1, which is the lowest band of your Q2 or the highest band of your Q1. So if there are numbers there, those are the two numbers you will use to calculate your interquartile range. The line in the middle is always the median line, right? Now, if you look at the box and whisker to your left, you will realize that that line is not necessarily at the exact middle of the highest and the lowest point. In reality, median is not always that way because this is a distribution. Because it's a distribution, you may not have it as exactly at the middle. It does not mean that that is not the median. But when you follow a distribution, you realize that depending on how the frequency is, your median may not necessarily just split your data from an observation point of view, but when you look at it from a number or from a frequency point of view, it will actually split it into two. But that black line is always your median, and the X is your arithmetic mean, right? And you could also be asked, for example, maybe additionally to say, oh, calculate what we call the upper fence and the lower fence. In the calculation of the upper fence, there are three things you need to bear in mind. 3 things. Number one is that you calculate your fence with your IQR. So the very first step is to calculate your interquartile range. The second thing is that there is a constant number in that formula, which is 1.5. Don't ask me. I don't know. I mean, there is clearly a reason for it, but again, it's 1.5, right? And so remember the 1.5. Remember that you're using your IQR. And then the third thing you need to remember is that when you're dealing with your upper bound, you add. When you're dealing with your lower bound, you start your formula with a negative, because you know your lower bound, you whatever you want to get, you want you to take it lower. You want it to take it lower from your lower bound, right? And whatever you get from your QR or your Q3, your upper bound, you want it to take it higher. And that is why you can leave the Q3 calculation in positive, but the Q1 calculation you start it with a negative. So always remember that you have to prep the formula that way for you to get your right answer. So three things to bear in mind: start with your IQR, then there is a constant of 1.5, and then you add your upper bound, and then you deduct your lower bound, but always prefix your calculation with a negative for your lower bound. Um, just speaking to the median example I mentioned earlier, when you look at the box and whisker here, for example, you will realize that the median is not exactly where you would call the middle. And and here this question kind of buttresses that, to say, now when you look at this distribution, you might want to say, oh, the median would be your bin 3 to 8, because it's kind of like in the middle. But that's not how it works. Now, the way it works is that you have to, because each of the bar represent observation. So for the very first bar, for example, for the very uh, first bar, which is minus 37 to minus 32, there is one observation there. Minus 27, minus 32 to minus 27, no observation. Minus 27 to minus 22, one observation. Now, so the way to calculate this is actually to accumulate or to count up. Now, in this actual question, there are 50 observations, right? And which means the middle would be fall between 25 and 26 when you use that formula. So what you then do is that you add up all of the observation until you get to 24 or to 25 or 26. And so if you add 1, which is the first bar, to the 1 in the third bar, and the next one, and the next one, and then the fifth bar has 4 observation, that takes you to 8. And then when you add the 3 of the next, it takes you to 11. And when you add the 2, it takes you to 13. And when you then add the next 7, it takes you to 20. And when you add the next one, it takes you to 24. So you see that you get to 24 in being 8 to 13, around 8 to 13. So it tells you that your observation 25th or 26 or 25 or 26, which is like in the middle, should then come up at around being 13 to 18. And that is how to approach this. So if you see something like this, it's important that you calculate it from a frequency point of view, cumulative frequency point of view, that is. So it's not necessary, it's not just a question of, oh, let me look at what split it in the middle. The correct way to look at it is to cumulate the observation until you get to where the median observation is. And that is where your answer would be. And also, from measure of central tendency or measure of location, we can then also look at some measures of dispersion. Now, what is dispersion? Dispersion is how spread something is around the mean. So from a return point of view, how spread are the return observation from the mean observation? And that's what dispersion is. Now, the most simplest measure you can calculate here is the range. The range simply takes the difference between the highest frequency and the lowest frequency, the highest value and the lowest value. That is your range. But we have much more exciting dispersion calculation called the MAD, the mean absolute deviation. The mean absolute deviation, it's superior to range. And the reason why it's superior to range is that it uses all of the observation. Now, the reason why I'm pointing this out is, there's just so many ways in which your knowledge could be tested in terms of how in terms of your understanding of these things. So both from a calculation point of view and both from comparative point of view, that okay, what is really the advantage of a range could be in a statement, it could be in any format that you get. But being able to know that, oh, this is what differentiates a range from a mean absolute deviation, this is the advantage of this over that, that kind of relationship, they'll all be very valuable for you to go into the exam with. And so the math uses all of the observation, unlike your range that uses only two, the highest and the lowest. And also, math is difficult to manipulate mathematically. It's difficult to manipulate mathematically, and that is an advantage. Again, over the range as well. And to the right just gives you a view. For some of you who might have a bit of challenge in, how is this calculated, right? When you're calculating, okay, I think this is um um downside deviation. Okay, I think I'll talk to that later. Variance and standard deviations. Variance and standard deviation, that you see that almost throughout. In fact, it's the foundation for a lot of the discussion in QM. Apart from the main, the next is variance and standard deviation, and you use it a lot. Simple formula for variance, and really, what is variance? Variance is the difference between your observation and your mean. That's what how does your observation vary from your mean, and that's what variance is called, right? And so when you look at it, you will see in the numerator, you will see that your observation, your x1 minus your x bar, which is your mean, and then when you square that, and then you put it over your denominator, which is your degree of freedom, then n minus one, then you have your variance. Now, this is for sample mean. Now, if for sample variance rather, if you're using population, you do not need to use n minus one. You simply can just use your n. But if it's a sample, you have to use n minus one. The n minus one is called degree of freedom, and the reason why you have n minus one is, think about it. If you have a population of 100 and you're drawing a sample, it means that the highest number you can draw that you can call a sample is 99. If you draw 100, it won't be called a sample because that will be the population. Therefore, for you to say this is a sample, it must be n minus one. That is, at least one must be taken out from it for it to qualify to be a sample, and that's what degree of freedom is. Because if you can decide to draw a sample of 10 out of the 100, you can decide to draw a sample size of 20, you can decide to draw a sample size of 50, they are all fine. But if you draw 99, it's still fine. But if you draw 100, it's no longer a sample. You're drawing the entire population. And that's where the n minus 1 comes from. Coefficient of variation is another measure. But for coefficient of variation, it's simple to calculate. It's just your standard deviation over your mean. It's that simple. But what you need to bear in mind going into the exam hall is that the coefficient of variation is a measure of relative dispersion. Unlike the others that are measure of absolute dispersion, this is a measure of relative dispersion. So when you're looking at alternatives where you're looking at, oh, am I looking at an absolute dispersion or am I looking at relative dispersion? And you need a measure that captures a relative dispersion, then it means you should be looking at your coefficient of variation against other measures like a variance, standard deviation, and the rest. Secondly, your coefficient of variation permits direct comparison of dispersion around different database. So when you're looking at an alternative where you want to be able to compare across different data sets, then you need a relative measure, and your coefficient of variation would serve that purpose. And your CV is a scale-free measure. That is, it has no unit of measurement. What that means is that if you calculate it for dataset A, you calculate it for dataset B, you can compare it. It's not in any unit. It's not in any unit. It's just a number. there. It's not in percentage, it's not in decimal, it's not, no, it's just what it is, and it's comparable across data set. And that's what that is. So when you it's important that you familiarize yourself with this relationship, or understand this relationship in answering questions relating to measure of dispersion. Now, downside deviation. Downside deviation. So when you look at standard deviation looks at deviation to the mean. Deviation to the mean, right? As I mentioned earlier. But when you're looking at downside deviation, you're not looking at it to the mean, you're looking at it to its particular target. Now, from a professional point of view, what is risk? Risk is that what you're getting is not what you you expect to get. For example, if someone promises you that, oh, I'm going to give you a 1 million naira, right? Then that's a promise. Say the person says, oh, I'm going to give you a 1 million naira tomorrow, right? That's a promise. You will expect to wake up tomorrow, come to wherever agreed place, and collect your 1 million naira. But guess what? The person can come tomorrow and say, you know what? I have some cash flow issues. I'm going to give you 800,000, and then maybe we'll spread the rest. Now, 800,000 is not 1 million. That is a risk. The risk that you're not getting it. But again, the person can come and say, oh, I'm feeling very happy today. Today is my birthday. So rather than give you 1 million, I'm going to give you 1.4, right? That is still a risk from a professional in a strict risk conversations, risk definition point of view. As long as what you're getting is not what you're promised, that is, as long as what you expect to get is not what your observation is not what you mean, or what you expect to get is, there is a risk involved. But guess what? If you invest in an if you make an investment where you expect to get 12% and you get 20%, will you be worried? No. So from a practical point of view, what investors, or what we tend to be more particular about is downside risk. The risk that what we get is not up to what we expect, not more than what we expect. And that's where the intuitiveness of the downside deviation comes from. Now, the formula for downside deviation is similar to your standard deviation. The square root is the square root of your variance, as you can see. Your x is your observation. Your b in your standard deviation or in your variance is your x bar, which is your mean. But in this case, it has been replaced with the target. So if you see a question or a scenario in which you're given a target, that target simply replaces your mean in your calculation, and you continue your calculation the way you would do your standard deviation calculation, actually. But you must take into consideration the following. The n does not change. So remember that when you calculate a standard deviation, let's say your observation is 10, and then you have a target. When you have a target, now look at the table by the right, for example. When you calculate standard deviation based on this table, you will calculate deviation for all of these observations from January to December. They will all have deviations, right, from the mean, positive or negative, and then you square that to get a positive number. But the moment you put a target, in this case, a target of 3, you will realize that January, February has no number, May has no number, August, September has no number, right? And then you end up with how many numbers, how many deviations? 1, 2, 3, 4, 5. Now, you might then be tempted to say my n is 5. No, your n is still 12. Your n is not 5. So your n does not change, right? What that would mean eventually is whenever you're calculating a downside deviation, or a deviation that does not take into consideration all of the observation, you're always going to end up with a smaller number than your standard deviation. So when you calculate your downside deviation, it's going to be smaller than your standard deviation where you use all. So clearly looking at it, if you're looking at a scenario in which you're given a standard deviation and then you're asked a downside deviation, then clearly just be looking for a lower number, right, from your standard deviation, because your downside deviation will always give you a lower number than your standard deviation. The other thing is, if the target is higher, there will be more deviation below target, so square deviation will be higher. What do we mean? In the table by my right, deviation is set at the target of 3. Now, if deviation is set at the target of 4, which means it's set higher, more and more observation will fail. And if they fail, it means you will have more deviation observation to work with. Now, in the case of 3, we have only 5. But the moment you increase it to 4, we'll probably have 6 deviation observation. When you square that and you calculate it, you will see that you arrive at a higher number than when the target was 3. So without doing any calculation, when the target is higher, there would always be more deviation below the target. And so your square deviation or your S target would always be higher. And so there are 2 things you have to bear in mind here. Number one, your downside deviation would always be lower than your standard deviation. And the higher you increase your target, the higher you increase it towards what your standard deviation is. If you increase it high enough, you're going to include all of the deviation, and you're going to end up back at your standard deviation. So it's important to understand that relationship, that that interplay, as you go into your exam hall. Now, let's talk about normal distributions. Let's talk about normal distributions. Normal distribution is, should I say, the bedrock of statistics, right? Because it is normal distribution. When you look at the central limit theorem, it's the reason why we can rely on a number of analyses that we do. In fact, it is the main reason why you could conduct hypothesis testing. Now, if there is no normality assumption, it will be much more difficult to actually conduct all of those hypothesis testing or rely on anything. But because there is normality, you could rely on that. But I mean, in going into an exam hall, you want to be very, very familiar with normal distribution and all of the variation around it. The first one is when we say positively skewed. Positively skewed is, so you could have skewness and kurtosis. We will look at kurtosis shortly. But when we look at skewness simply means that it is not normal. Anything that deviates from normal means it's skewed, right? And when it's skewed, it can either be skewed to the right or skewed to the left. It can be negatively skewed or positively skewed. Now, at what point do we say it is positively skewed or it's negatively skewed? First, let's look at the characteristics of a normal distribution. Number one is that its mean is equal to its median and it's equal to its mode. Now, you get a scenario in which you're given a mode. You do not need to calculate your mean or you do not need to calculate your median because it's the same. Now, let's say you have an observation in which the mode is given as 26. Take that as your mean, take that as your median. Because as long as it's a normal distribution, the mean is equal to the median and it's equal to the mode. And in that table or in that chart of normal distribution, that is the peak you see there. The highest peak in that distribution on this, I don't know if you can see, I'm not sure you can see my cursor. This very point here, right? That is your mean, because that highest point is your mode. And because that highest point is your mode, it is also your median and it is also your mean. And so for a normal distribution, mean, median, mode are equal. The second thing is that for a normal distribution, it is completely described by 2 parameters, the mean and the variance. And that is why when we go to central limit theorem and we make that assumption to say there is normality, we can then say that our observation or our data set is described by just mean and median, by mean and variance. And we can then carry out all sort of hypothesis testing and all of that on the basis of that. So that's on normal distribution. But what do we mean when we say positively skewed? Now, positively skewed, one of the confusion that candidates also often faced, and I faced it personally for a long time, just understanding where the tail of this distribution is. But the tail really is that long leg you see there. But how also do you interpret this? You see, the high mountain, if you look at the positively skewed, the high part where you see the mode is frequency. That side is frequency. So when you look at the high where you have the mode, it means that the frequency there is high, right? When you look at the tail side, the frequency there is low. But what you will also notice is if you should graduate this chart, that is, you label it 0, 1, 2, 3, 4, you will notice that on the tail side, you will have extreme values, because you can have there's tendency for you to have a lot of stretched out numbers on the tail side. For example, if the mean of this distribution is, say, 50, the median will be around 20, the mode will be around, say, 10. But what if you stretch that from mean up onto the tail side? You realize that you probably get to 200 or 300 from that mean of 50, because it is much more stretched out. What that means is that you have extreme value. They are not very frequent because of when you look at the frequency, but when they occur, they are always extreme. And that's how you know it's positively skewed. So positively skewed, if you want to be able to demonstrate it, has its tail by your right hand side. So when you're looking at the screen, look at where your right hand is, and if that's where the tail is, that is a positively skewed, distribution. But in a positively skewed distribution, the additional thing you must know and be very, very familiar with is, in a positively skewed distribution, the mode is always higher than the median, and the median is always higher than the mean. Oh, sorry. The mean is always higher than the median, and the median is always higher than the mean. Now, this might look counterintuitive, and that is why I use the frequency to explain it initially. But when you look at the stretch out part, imagine that this mean is 50. The mean point for the positively skewed is 50. It means that the number before it will be a smaller number, right? Say 20. So you can see that the mean is actually greater than the median. Do not look at it from a frequency point of view. Look at it from the actual value of the mean, because that's what that measures. So in a positively skewed distribution, the mean is higher than the median, and the median is higher than the mode. It is not the other way around, because you see that the frequency in the mode side is higher. No, that mode is actually smaller because it is to the left-hand side of the mean, right? Now, when you then go to the negatively skewed, the reverse is the case, which means the mean is lower than the median and the median is lower than the mode, because you see that the mode is to the extreme right-hand side. The extreme right-hand side is where you have the higher numbers. But you also notice that in the negatively skewed negatively skewed distribution, you have the tail to the left-hand side. Just to confirm that you can still hear me, I just want to be sure I'm still audible. I lost connection on my other laptop. I just want to be sure. Yeah, okay. Thank you for the feedback. All right. So you want to be very familiar with your ability to explain what positively skewed is and what negatively skewed is. And in explaining it, you want to understand what detail really means, where extreme values are, where higher frequency is, which one is higher in between the mean, median, and the mode, when you're in positively skewed or negatively skewed. You want to be very, very comfortable with that. If you do need to calculate, the formula is given, in that body of that negatively skewed. But the difference between the formula for skewness and that of standard deviation is that it is raised to the cubed root. So it's raised to cubed root, and then the s is also raised to power 3. And then you have your 1 minus 1 over n multiplied by whatever that is. Now, when you do your standard deviation, right, you typically do squared. But when you're doing skewness, you do raised to power 3, and then the s is also raised to power 3. And don't forget to multiply by 1 over n. A distribution that is not symmetrical is termed skew. Symmetrical means that you have equal value on both sides. A normal distribution is symmetrical because you have equal value on both sides. A return distribution with positive skew has frequent small losses. Now see, frequent small losses. The frequency is high, but the losses are small. That is for your positively skewed. And few extreme gains. The frequency is few, but when they do occur, the gains are extreme. And that's where when you look at the tail side of the positively skewed. The reverse is the case for negatively skewed. Return distribution with negative skew has frequent small gains and few extreme losses. And so you want to be very comfortable with that as you go into the exam hall. What about kurtosis? Kurtosis is the measure of the combined weight of the tails of a distribution relative to the rest of the distribution. Thankfully, we've already discussed what the what the tail of the distribution is. For a long time, personally, I couldn't just figure out what the tail is. I mean, when you look at it, you would think that the protruding parts, that top part, is the tail because it really looks like a tail, but that's not where the tail is. The tail is the extreme two ends, right? And what kurtosis really measure is that when you look at the weight, if you look at the dotted line, we say that is fat tail. Man, when you look at it from the relative to the normal distribution, you will notice that it is thinner when you look at the top part, right? This part. So you might be tempted to say, oh, that is thin-tailed. It is not. Because what you're looking at really is the tail side. And what do we mean by the tail side, right? When you look at the dotted line, you will see that it has more value to the extreme than the normal distribution. So for the normal distribution, the extreme value could be 1% of the total distribution. But for the fat tailed, the extreme value could be up to 5% when you add the extreme to the right, the tail to the right, and the tail to the left. When you add those two together, it could be up to 5%. And that's what kurtosis measures to say the 5% is higher than the 1% for the normal distribution. And that is how you measure kurtosis. It is the combined weight of the tails of the distribution to the rest of that distribution. And we could have what we call fatter tails, which is leptokurtic. This one you want to be able to remember it. Thinner tail is platykurtic. Normal distribution is your mesokurtic. Normal distribution is your mesocortic. So they just put a name there, just so that maybe perhaps it's balanced. A fat-tailed distribution tends to generate more frequent extreme large deviations, and this is the explanation or the meaning of fat-tailed. Now, we've already explained what tail is, where you have extreme, right? Extreme deviation, where you have the extreme. So you see that for a fat tail, there are values to the extreme. Thin tail tends to generate less frequent extreme large deviations. And so that is how to differentiate between fat tail and and thin tailed. Now the table here, just to build on our understanding, if kurtosis is above 3, then that is fat tailed. So when you calculate your kurtosis, and there's a formula to that from a calculation point of view, when you calculate it and the value you get is above 3, then you conclude that it is fat tailed. Or when you're given numbers, perhaps you could even be given numbers and you're just given perhaps as regression numbers or ANOVA numbers, and they just tell you that, the kurtosis is this. You could simply just look at that number. Let's say that the number is 3.5. 3.5 is above 3. That means that distribution is fat-tailed. If you look at that number, let's say the number is 2.8, which means it's less than 3, you will say that the number is thin-tailed. But if it's 2.8, for example, which is very close to 3, you could then be saying, oh, okay, perhaps it's mesocortic. Because when we say normal distribution, it does not mean that it is smoothly normal. You will hardly find a smooth normal distribution. So there will always be that slight variation in the smoothness or in the normalness, And so 2.8, 2.9, you could argue that it is close to 3, and so you might want to stick with mesocortic. But generally, if it's less than 3, you will say it is thin-tailed or platycortic. What about correlation measures? What is correlation? Now, first thing to remember with correlation is the formula. Now, it's important to remember this formula because you would see this formula over and over again later on in the study. And you must be very familiar with how to move from correlation to covariance back to correlation to covariance. What is the relationship between covariance and correlation? Because typically, in scenarios you could face, you could be given either of the two. If you have covariance, you should be able to use that to calculate your correlation. If you have correlation, you should be able to use that to calculate your covariance. So you want to be able to understand the relationship between correlation and covariance, and you want to be familiar with moving from one to the other. Depending on whatever you're presented with, you should be very comfortable with using one to calculate the other and the rest. The sample correlation coefficient is a standardized measure of how two variables in the sample move, right? That's correlation. It's a standardized measure of how they co-move or how they move together or co-move. The sample correlation coefficient, RXY, is the ratio of the sample variance. Now, what I'm describing here is simply what is in the formula. The ratio of the sample covariance in the denominator, to the product of the two variables standard deviation. XX and XY, these are the standard deviation of X and Y, which is the product of it. And so that's what it just says. Now, when you look at it from a property point of view, which is what you should be quite familiar with, correlation ranges from -1 to +1. For any random variable. Correlation of 0, termed uncorrelated. So when you have correlation of 0, it means that there is no correlation. It means that they simply they have no relationship. They don't co-move. That's what it means. Indicates an absence of any linear relationship between the variables. And this is very important. Very important because correlation measures linear relationship. Linear relationship. Okay. Let me put it this way, right? If you put your hand in, what's the best way to do this? Okay, so let's say the example is not. So let's just go with it. So the thing here is, it's always very important to be careful when you're explaining or interpreting correlation. Because what correlation is designed to pick is linear relationship. It does not mean there is no relationship. There could be other types of relationship that exist between variable X and Y. But if it is not a linear relationship, correlation won't pick it. So you might be faced with a scenario where the correlation is 0, and then you say, oh, there is no relationship. It does not mean there is no relationship. The correct response would be there is no linear relationship. And that is important because there could be non-linear relationship. If there is a non-linear relationship between two variables, correlation could still be 0, which means it will tell you there is no relationship or no linear relationship. That's what correlation is saying. So it's always important to be careful when you're interpreting correlation of 0. It means absence of linear relationship, not that there is no relationship. A positive correlation close to +1 indicates strong positive linear relationship. Again, you cannot say it indicates strong relationship. It indicates strong positive linear. Always include linear relationship. So if I have correlation of 0.98, that is close to 1. That is close to 0.1. That is strong. If I have the correlation of minus 0.98, that is also strong, but it's negative. So I would say that it has strong negative linear relationship. So both are strong. As long as they are close to 1, they are strong. So if you are looking at, which one is the strongest between minus 9.8, minus 0.98, minus 6.8, and plus 2.5, you might be tempted to say, the 2.5, because it's positive and the rest of negative, it means it's stronger. No, the strongest would actually be the minus 9.8 because it is closer to 1. It's closer to -1. So the closer to it is to 1, either positive or negative, is the measure of strength. The sign is the measure of direction. How close it is to 1 is the measure of strength, either strong or weak. The sign is the measure of direction. Positive means they move in the same direction. Negative means they move in inverse direction. Now, what does inverse direction mean? It means that if I am facing point A
Then the other variable x is facing point V, which is opposite to where I'm going to, right? And that's and to put it as an example, right? Remember when we used to have when we had like fuel scarcity, right? Because the price of fuel has gone up maybe significantly, you will see that the rate at which people drive will reduce. That is a negative relationship. That is an inverse correlation, which means what that means is the price of fuel affects driving. Yes, so there is a relationship, right? But it's a negative one because the higher the price of fuel goes, the lower people would drive, the less mileage people would cover or kilometers they would travel because of higher fuel price. That is an example of inverse or negative relationship. And a correlation of one indicates perfect linear relationship, and -1 indicates perfect relationship. It's important to note the limitation of correlation. It's only measure linear relationship, and I think we've spoken to that quite exhaustively. It's unreliable measure when outliers are present in one or both variables. So when there are outliers, you really can't rely so much on correlation. It's not very reliable when there are significant outliers on either of the data or both variables. And then correlation does not imply causation. So the fact that there is a correlation, it could be positive, it could be strong, does not mean that there is a relationship necessarily, because there's something called spurious relationship. Spurious relationship. It's like saying that, oh, that we have higher numbers of lizard in Lekki than we have in Ikoyi. I mean, technically, there is nothing economically or environmentally that we could say would result to that. It just happened by chance. And so, even though you run the numbers and you see a positive correlation, it does not necessarily mean that there is a relationship. And that's what we mean. So, it's always very important to be careful when interpreting relationship. So, let's look at probabilities and conditional expectations. First and foremost, you want to be able to calculate expected value of random variables. The most important one really is the value of your expected return. And the way to calculate expected return is the probability of return multiplied by the outcome. Typically, when you're calculating return based on scenario, look at the table to the right. The probability that earning per share will be 2.6 USD is 0.5. The probability that it will be 2.45 is 0.4, and to the last one. What you will notice with the probability distribution is that it sums up to 1, which means it captures all of the scenario. What you have seen, what each of the line represents is a scenario. In a scenario in which the scenario in which EPS is 2.6, there is a probability of that of 0.15 probability of that happening. There is a 0.4 probability of a scenario where EPS is 2.45. So if you want to calculate expected return in this kind of situation, you simply just multiply the probability by the outcome, and then you sum it together. And that's what that formula says. It's as simple as that. So when you're calculating expected value for random variables, for your mean, it's that straightforward. There's no complexity introduced. Variance is the same thing, but you see, when you follow this formula, for example, it makes it look like, oh, it's, but really when you think about it, how do you calculate variance? Typically, you take your observation, right, minus your mean, right, and then you square that. That is the same thing that you see here in the formula. The only thing that has been introduced is that you then multiply each of that by the probability of that scenario happening. That because each observation is a scenario, it's an outcome of a scenario, and there is a probability of that scenario occurring. So what you just do, the additional thing you do here is simply to multiply by the probability when you're calculating your
your variance. Now, there is something called the total probability rule for expected value. Total probability rule. The total probability rule is very it's very powerful and very useful in probability, and in fact, in some of the other discussions that we'll be having. And what does it really say? It simply says that the probability of X, the probability of an event X, right, is the probability of S given all of the scenario, right? Right? Given all of the scenario multiplied by the probability of that scenario. Now, this formula of total probability is the same thing we have described here. Now, take EPS as an outcome, take 0.15 as the probability. So if I want to calculate expected return next, for this period, I'm going to take the outcome. In this formula, that will be your EX, by S. That will be your 2.6 here, multiplied by your probability of that scenario, which is 0.15. Now, when you look at that, that is my PS, plus probability that does not happen, something else happen, in this case, 2.45, multiplied by the probability, or that outcome multiplied by the probability that happened, which is, in this case, my PSC, right, which is 0.45. Now, this formula is just a short form to say probability that of a scenario happening, right, the outcome of a scenario multiplied by the probability of that scenario happening, multiplied by the outcome of the scenario not happening, multiplied by the probability of that scenario not happening. When you add both together, that will give you the probability of a particular event. It is the same thing we've done here, because in this case, there are 4 scenarios. I take the outcome, I multiply by the probability of that scenario happening, and then I add the others to it like that, right? And what you will notice here is your PS and your PSC must always be mutually exclusive and exhaustive. What do we mean? Mutually exclusive and exhaustive is that they cannot happen at the same time. For example, rain. If it rains, I cannot say it does not rain. So if it rains, either it rains or it doesn't rain. If it does not rain, I can't say it rains. That is mutually exclusive, right? I can't. So in probability, you cannot eat your cake and have it back. If you're eating your cake, you've eaten your cake and it's gone. And if you've not eaten your cake, you have it and you still have it. But in probability, you cannot eat your cake and have it back. That is mutually exclusive. Exhaustive means that all of the scenarios have been covered. How do you know that all scenarios have been covered? All your probability must sum up to 1. Because all of the scenario that can possibly happen, for example, the scenario for rain is it can either rain or not rain. So if it rains, that is a scenario. The other outcome is that it might not rain, which is, if I add not rain or rain together, I get 1. Which means if anyone asks me on a particular day, did it rain? I have only 1 or 2 options, yes or no, which means it is exhaustive. And that's what it means. How do you know it's exhaustive? Just check that the probabilities sum up to 1. That's how you know. Now, how do you use this? Because when you look at the table by the right, how do you use this? How do you do calculation with this? There are things that could be used in your scenario that, if you do understand how it plays out on this one, you will be able to you draw your probability tree. This is called a probability tree, and then you'll be able to make calculations with it. Now, the explanation of this tree is that there is a 60% probability of interest rates declining, 60%, and that is this point. Now, if interest rate declines, there is a 25% probability that EPS will be 2.6, and there is a 0.75% that EPS will end up at 2.5. So each of this is a scenario. So circled here is a scenario. This 7.5 and the EPS of 2 is a scenario. Now we are saying that these 2 scenarios, they are possible under the major scenario that interest probability, or that interest rates declines. What if interest rate remains stable, which is a scenario on its own? Under that, there are 2 other sub scenarios. If it could be, there's a 60% probability that it will end up at 2.2. or 0.4% or 40% probability that it will end up at 2. Now, this is the outcome. The EPSs that have been shown are the outcomes. Now, the scenario is the probability of it happening and the outcome. And then the probability of that scenario occurring is, as I've highlighted here. Conditional probability, the unconditional probability here is 0.5. And you will see how that's important. This 0.5 is how you arrive at your total probability rule. For example, the probability under the first outcome, the topmost outcome, is your 0.25 multiplied by your 0.6. That's what gives you that 0.15. So if you have a table like this and you need to derive that probability at the last node, that is for this first part, what you need to do is to multiply the preceding probabilities that have led to it. In this case, 0.6 multiplied by 0.25 will give you this. And for this one, for 0.45, 0.6 multiplied by 0.75 will give you this. And then for this, 0.4 multiplied by 0.6 will give you this. And then for this, 0.4 multiplied by 0.4 will give you 0.16. That's how you arrive at that, right? Now, we can then take that further. When you look at this question, which I've also copied from your curriculum, you can see that it asks you to calculate that probability. It also asks you to calculate operating cost. For the operating cost, it has given you a model, which is your estimated Y is equal to 1.5 plus 0.65x. Now, your X is your number of branches. So it means you only need to substitute your branches into this. So in the first scenario, you substitute 1.25 into this. So you have 1.25 or 12.5 rather plus 0.65 multiplied by 125. And that will give you the operational cost of for that scenario. But for the probability, like I mentioned earlier, you simply multiply the probability that led to it, which means 0.8 multiplied by 0.5 is how you will get the probability in this node. And then for this second node, 0.8 multiplied by 0.5 is how you get this. Notice that for every scenario that says every branching out, it must always equal to 1. Here's what it would mean. 0.5 for the first scenario under the 0.8, 0.5 plus 0.5 equals 1. 0.85 plus 0.15 here also equals 1. Then when you go back to the node one step further, 0.8 plus 0.2 also equals 1. And so it tells you that there is, the exhaustive and mutually exclusive, assumption being, upheld throughout that tree. That's just the way to look at it. For base formula is an area where a lot of candidates also struggle. But what is base formula really? We're saying that if I have expectations and I've already calculated my probabilities. So for example, let's say I'm doing inflation calculation and I'm saying, there's a 50% probability that inflation will go up to say 30% next year, as an example, right? And then suddenly something happens. Maybe a major news comes out, or say Dangote Refinery says, oh, you know what, we've been able to get crude now, and so we can refine to any limit we want, and there's no problem, and all of that. So that information comes into the market. How am I going to update the 50% probability they already have of inflation going up to 30% by next year? Right? How do I update that? That's what base says. And it's very simple. What base does is that base is a rational method for adjusting our viewpoint as we confront new information. And so base formula works in reverse. So it reverses the given information, and we'll see that shortly. And so sometimes base is called inverse probability, just because it inverses, the event and the information. Users of Bayesian statistics do not consider probability or likelihood to be known with certainty. So they believe that it should be subject to modification. So what they are saying here is, if I have a 50% probability that inflation will go up next year, I should be willing to change that if I have new information. And Bayes can help me to make that. The formula for Bayes is simple, and that's what is given here. Probability of an event given an information is equal to the inverse. That's what we've talked about. Probability of information given an event over the unconditional probability of new information multiplied by the prior probability of that event. Now, this is where a lot of candidates might find this a bit confusing. Number one, understand what that formula is. The top part, which is probability of information given event, is called likelihood, and the prior is the pre-event is the prior. The total probability rule is what you use to calculate your P information, that is the unconditional probability. It is your total probability rule, which we've discussed earlier. In any scenario you're given, there's every likelihood that you'll be given your prior probabilities. In the question in your curriculum, you will notice that prior probabilities were given. And in this case, 0.45, 0.3, 0.25. And then also likelihood of the new information was also given, right? And the new information is drive made expands. The event is EPS exceed consensus, right? And so the likelihood for the new information is given. Once you're given these two information, the prior probabilities and the likelihoods, you can easily calculate your base. Your base. You can use your base. And there are just two simple steps to follow. Number one is to calculate the unconditional probability of the new information. And how do you do that? Look at the likelihoods. The likelihoods are being given, and the likelihoods, you will see that already the likelihood already covers all of the scenarios for that new information. The new information in this case is drive made expands. That's the new information. And so what this means is that to use this, I would say drive made expand given EPS exceed consensus 0.75 multiplied by the probability that EPS expands, which is the prior probability of EPS expand exceeded consensus rather, it will be 0.75 multiplied by 0.45 plus 0.20 multiplied by 0.30 plus 0.05 multiplied by 0.25. I will add that together. That is my total probability rule, and that gives me P information. That is, it gives me the unconditional probability of the information drive made expands. That is the first step. So you use your total probability rule to calculate your P information. Once you have done that, the next step is simple. You already have your P information given events, right? Now, so in the first instance, let's say that what you're interested in is you want to update that EPS exceed consensus. That's the one you are interested in. It means you're simply going to take drive made expands, EPS exceeded consensus, which is the flip of that particular event and information, which is 0.75. You will multiply that by the probability that EPS exceeded a consensus, the probability of that event, which is 0.45, and then you divide it by what you've calculated earlier through your total probability rule. And whatever you get is your answer. So 2 steps. First one, use your total probability rule to calculate your probability, unconditional probability of new information, and then use the prior and the likelihood that you've been given to calculate your base. So when you have a scenario like this, it's just always important for you to extract the information you need and follow these 2 steps, and then you should be able to calculate it without any hassle. Portfolio mathematics, 2 things to note here. Number one is how do you calculate the expected return of a portfolio? Now, remember that in a portfolio, there are different assets. Now, as you can see in the table, you have your asset class, your S&P 500, your US long-term corporate bonds, and your MSCI, EFE, right? And there's weight apportioned to it, and there's expected return for each of the portfolio. So this is weighted average, really. So you multiply by the weight by the expected return, and you simply just add it. It's that simple. But when it comes to calculating the variance and the standard deviation, it's much more nuanced, right? But here's what you should get familiar with as you go into the exam, as you go into your exams. For any given number of assets, Variance is always equal to the number of assets because that could be tested. Number of covariance is your n multiplied by your n minus n. So if your number of assets is 2, then the number of covariances you will have will be 2 multiplied by 2 minus 2. And then the number of distinct covariances. Covariances is different from distinct covariances. So you need to look at the scenario you're given and be sure what you're asked. You could be asked covariance, which is simply giving you the total number, and then you could have distinct covariance. My name is Olabode Williams, right? I could also have Williams Olabode, which really is the same, but I'm going to count it as 2 if I'm counting covariance. When I'm counting distinct covariance, I'm going to count it as 1 because Olabode Williams is also equal to Williams Olabode. And so now that's what that distinct covariance says. And to get your distinct covariance is n into bracket n minus 1 divided by 2. As the number of holding increases, and this is very key, covariance becomes increasingly important, all else equal. So as you add more holdings, so let's say you move from 5 assets to 6 assets to 7 assets, the role of covariance in your portfolio becomes much more important. Covariant terms capture how the co-movement of the return affects aggregate portfolio. So what does covariance measure? It tells you how the interaction of the assets in the portfolio play out in the portfolio variance. That's what covariance measures. Covariance of returns if is negative if when the return on one asset is above expected value, the return on the other asset tends to be below expected value. That is when one is going up, the other one is going down. That is negative covariance. Positive covariance is the opposite. It means they tend to move in the same direction. Now, positive covariance does not mean that they are moving in the opposite, they are moving in the positive territory. So if stock A, for example, is going down and stock B is going down, that is positive covariance, not negative, because they are moving in the same direction. What that measures is direction, not necessarily sign or where they are going to. It's only negative when they are moving in opposite direction, but it is positive when they are moving in the same direction, either positive direction or negative. Either they are going up together or going down together. Covariance of random variable with itself is called own variance. That is, the variance we've been talking about really is the covariance of an asset with itself. Covariance of X with X is variance. And when you go back to the calculation of variance, you will see that what we've done is X minus X bar squared, which means X minus X bar multiplied by X minus X bar. So technically what we've done is variance of X with itself. And that is variance. Important to note that. Now, I put this here just for you to show. Now, in the last slide, I already talked about as you add assets to your portfolio, your covariance becomes much more important, right? How does that play out in your portfolio? And if you see a scenario in which this is being kind of looked at, you know how to approach it. The diversification benefit increases with decreasing covariance. Now, look at the covariance term, which is the last part. If it's positive, if this is positive, it's going to add to the overall variance. In this case, it's 4.4775. It's going to add to the variance. Why? Because it's positive. The covariance is positive. What if it's negative? If this is negative, it means that the variance will now be 191, which is lower than 195, right? And that is the importance of having negative variance. So to maximize the benefit of diversification, it is best to have assets that are negatively correlated. Assets that are negatively correlated are the best way, to benefit from diversification and reduce portfolio risk. Again, remember, the description of your correlation. Now, imagine you have this scenario. You will notice here that expected return has been given, standard deviation has been given, current portfolio weights given, correlation between assets given. You might be asked here to calculate variance and standard deviation. What you will notice here, okay, standard deviation is given. What you will notice here is you can use this to calculate all of the calculations we've talked about. For example, if you want to calculate the weighted average, you already have the portfolio weights there that you can multiply by the expected return. For the standard deviation and the correlation, you can use that to find what the covariance is because of this formula. Because your covariance, your correlation is your covariance over the product of the standard deviation of X and Y. So if you remember this formula, that's why I said it's important for you to remember this formula and be able to translate this formula into covariance and back. You should be able to even use this formula to get the variance or the standard deviation of either X or Y, because you could be faced with a scenario in which the standard deviation of one of the two is missing. You want to be able to use this formula to be able to calculate it. So let's look at the safety first rule. Safety first rule really is talking about what is the minimum acceptable return. And so if a client has a minimum acceptable return, how do you get there? When you look at the panel A, for example, what you should simply look at for if you're given such a scenario as this, or if you're faced with a scenario as this, is look at the probability of earning less. That is what is important, not the probability of earning more. Always focus on the probability of earning less, because that is what minimum acceptable return really looks at. The probability that you will earn a return that is less than a particular threshold. And so on the basis of that, the one that has the lowest probability of earning less than 2% is your portfolio 2. So if you're given something like this, that gives you a clue in terms of what to expect. And for your safety first rule, you want to be able to calculate your SF ratio. Your SF ratio simply takes the expected return on your portfolio minus expected return on your threshold. How do you get your threshold? Look at example 3. Now, a client has a portfolio of 800 Canadian dollar, and she wants to be able to liquidate 30 Canadian dollar. Now, if you read it further, it says without invading the initial capital. What that means is that at the point at which the client is liquidating, that portfolio must have earned $30,000, so that when the client takes $30,000, the initial capital will still be intact. And that's how you know what your minimum is. You simply take that over your 800, and that gives you the minimum return that the portfolio is expected to generate. And that's what you use to calculate your SF ratio. Remember that this criterion assumes normality, and that's why when you look at the chart here, you can see it's a normal chart. It's a normal, it's a normal distribution. So there's always that assumption of normality here. We don't talk about simulation method. Now, for simulation method, and talking about log normal distribution, two things to always bear in mind to know as properties of log normal distribution. It's bounded below by 0. That is, it cannot fall below 0. And it is skewed to the right. It has a long tail. We've talked about long skewness and long tail earlier. And you can see in the two charts that it actually has a long tail. Log normal distribution has been found to be a useful, accurate description of the distribution of prices for many assets. And the reason for that is asset prices are bounded from below by 0. I mean, you hardly go to the market and find any asset price, and I mean price, in negative. The price of the product you buy, the price of stocks, even return on fixed income, they are never negative. They are always positive. That tells you that asset prices are always positive. And so if you want a distribution that you want to be able to describe that, that observation, then log normal is the best to use. So log normal distribution is best used for price, while normal distribution is best used for returns. Log normal distribution is defined in terms of parameters of a different distribution. What do we mean? When you have log normal distribution, it always has an underlying normal distribution. And what you use to analyze that log normal distribution is the parameter of the normal distribution, the underlying normal distribution, that is the mean and the variance of the underlying normal distribution. And that's what we're saying. This simulation method, I put it here really just so that you get familiar with how this is calculated. Essentially, the in-log or log normal distribution, the daily log normal distribution, just to point out here that you take the day before, the day after, over the day before. So in the first calculation, you see that it is 7, that is 7,000 over Monday, Tuesday over Monday. For Wednesday, it's Wednesday over Tuesday. For Thursday, it's Thursday over Wednesday. And for Friday, it's Friday over Thursday. Even though we have 5 days, you see that there are 4 returns that are calculated. So it's always important to bear that in mind. And you can use these numbers to calculate your sum, to find your mean, and to find your variance, and to find your standard deviation. Now, if you're asked for annualized volatility, For analyzed volatility, you take your standard deviation and you multiply it by your T. T is typically the number of trading days, which is 250 standardized. But typically, I want to expect that might be given or stated somewhere. You could also use that information here to calculate continuously compounded annual returns. You just simply take your mean and multiply by the T. Like I mentioned again, could be 250. So it's as simple and straightforward as that. And then we look at bootstrapping. Bootstrapping really means when you take your sample from a population and then you then sample from that from that estimated population. Now, when you look at the chart to the right, you see that the first thing that was done was so a sample was taken from the true population, and then you then sample from that sampled population, or it's called estimated population. And so when you sample from a sample, it's called bootstrapping. Now, and the advantages to bootstrapping. Bootstrapping still offers a good representation of statistical features. And here's what we mean. If you look at the sampling distribution of the true population sample and the sampling distribution of the bootstrap, you will see that the chart, it's almost the same and it's normal. Again, it's not like it's normal. It's not smooth normal, but we still say that this is normal. What this says is that a lot of the properties that are embedded in the sampling from true population are also inherited in the bootstrapping. And that's what that says. Bootstrapping provides only statistical estimate. It's important that you know that it does not provide exact result. It only provides an estimate. And that's why you see estimate 1, estimate 2, estimate 3. And it's also called model-free resampling or non-parametric sampling because it makes no assumption. Bootstrapping makes no assumption, right? It does not make all of the assumption you make in your normal sampling, right? So that's why it's called model-free. Jackknife, there is a difference between bootstrapping and jackknife. And the simple difference is that with bootstrapping, you replace, with jackknife, you do not. So in bootstrapping, for example, you can find a situation in which one sample is drawn more than once. So for example, if I have a bucket of 10 balls and I'm drawing a sample of 5, I can draw one ball twice because when I drew the first one, I can put it back and draw from it again, which means I can pick the same thing I picked before. But in jackknife, I don't because I don't replace. So if I pick the first ball, I take it out. And then when I pick the second ball, I'm sure I'm not picking that first one I picked before. So how do you know this when you're faced with a scenario? Simply look at the observation. When you find multiple observations in your sample, it means that what was done was bootstrapping. Because it's only in bootstrapping that you would find a situation in which that you can see observation repeated. Observations can be repeated with bootstrapping, but with jackknife, observations will never be repeated. And also for jackknife, very important, the total number of sample you can draw is limited to your n because you do not replace. So if I have 10 balls, the total number of times I can actually pick is 10. Unlike your bootstrapping, I can do that sampling as many times. I can have 10 balls and I can, draw sample 200 times. But for jackknife, it is limited to n because you do not replace. Therefore, your total number of sampling is limited to your n. So it's important. This is the formula, for calculation purposes. For estimation and inference, so, the whole essence of quantitative methods really is to provide scientific method of, sampling, estimating, calculating, and all of that. But we also still understand that there are non-probability processes that people, or that researchers can often go through. Two of them are highlighted in the, in the curriculum. Convenience sampling is when you default to what is convenient for you. Let's say you're a researcher and you're researching the cost of Gary in Lagos, and you reside in Lekki. You could easily just go to the supermarket around Lekki on Sunday, no traffic and all of that, and just get the prices. But again, by the time you go to the mainland, you probably will find that the prices of Gary are significantly, different from what you have seen in Lekki. So what you have done would be called convenience sampling because you simply went to places that are easier. Judgmental sampling is when you're relying on past understanding or on the knowledge of a particular area, to do your sampling. That would be judgmental. But there are, sampling methods that was also discussed. The very first one is your simple random sample when you just draw randomly, right? You have your systematic sampling where you pick the keyed items. For example, you can pick the fifth of every, right? So you could just line everybody up and pick number five, for example. That would be your keyed. There's what called stratified sampling. For stratified sampling, what you first do is that you put people into subdivision or strata based on criteria, and then you select from all of the strata. Now, when you look at the under the stratified sampling, let's say that the green represents a male, the amber represents female, the green under represent boys, and the amber under represent girls. Now and this is population. What it means is that you divide by age group, which means you have male, adult female, boys, and young girls, and then you pick from each of those boxes. That way, you ensure you have a male, an adult male, an adult female, a boy, and a girl in your sample. And that's what stratified sample does. For clustered sampling, you simply just cluster people. And when you cluster, the number of clustering is typically the same. So you will notice there are 3, 3, 3, and they are mixed up. Boys, men, female, boys, girls, they're all mixed up. And then when you pick from a cluster, you do not necessarily have to pick from all of the clusters. You can actually just pick one cluster and as your sample. And so the major difference between random samples is that cluster sampling, is regarded as a sampling unit, and sampled as clusters are included. In stratified sampling, all stratas are included. All stratas are included, and therefore, stratified sampling is is the best approach for bond indexing. When you see a scenario in which what is talked about is bond indexing or ETF, just know that the best approach really is stratified, because that is what enables you to pick from all of the strata and have a better representation or replication, as the case may be. Central limit theorem allows us to make quite precise probability statements. Now, a lot of probability statements, because we cannot observe population, we have to rely on sample. And for us to be able to rely on sample, central limit theorem must hold. And what does it say? It says that given a population described by any probability distribution having a mean of mu and a finite reference variance, the sampling distribution of the sample mean computed from a random sample of size n from this population will be approximately normal, with mean of the population mean and variance, the population variance divided by n when the sample size is large. Now, here's what all of this is saying. To say it does not matter what distribution your observations are. It doesn't matter. But if you sample randomly and your sample size is large enough, the distribution of the sample will be normal. And here's what we mean. If I have 100 observation and I pick 10, and when I pick 10, the first 10, I find the mean of that 10. I pick another 10, I find the mean. If I plot all of the means that I've gotten, I will end up with a normal distribution. And in that normal distribution, my mean is going to be very close to the mean of the actual population. So if I can observe the mean of the population and the mean of my sample distribution is going to be the same, and the variance is almost going to be the same. And so what central limit theory then says is that if the n is large enough and we assume normality, then it means we can rely on whatever we are calculating or whatever judgment we want to make concerning our observation or concerning our data. Now, what is considered large enough from observation or a sample point of view, 30 and above? What that means is if you're faced with a scenario in which your n is not up to 30, you must view whatever you're doing circumspectly to say, if it's a scenario that is asking you to say, oh, can you really rely on this? Perhaps you want to start looking at maybe not, because at the point at which central limit theorems really hold and you can rely on everything else we do is when your n is large. If your n is not large, we can't say that whatever you're calculating is not really reliable. And so the distribution of the sample mean will have the following properties. The sample mean will be approximately normal. and then will be the mean will be approximately equal to the mean of the population, and the variance will be equal to the variance of the population. And so we have standard deviation and standard error. Now, this is just to show us that there is a difference between standard deviation and standard error. We've talked about standard deviation earlier. Standard deviation measures the dispersion around data from the mean. So if you look at how we calculate standard deviation, we're looking at the dispersion from mean, because you can see X bar there. But when we're saying standard error is as a result of using sampling rather than the population. So it's the error we encounter because we are using a sample. And that's what standard error means, right? But standard deviation is the deviation from mean. So those two terms are different, and so they are not the same. As you increase sample size, standard error reduces. So as you increase your N, your standard error reduces. And that's just to know that. Under hypothesis testing, it's important to know the processes of hypothesis testing, but I think the most important thing is the properties, the properties of your null hypothesis, how you state your parameter, and all. Your null and alternative hypothesis must be mutually exclusive and collectively exhaustive. Mutually exclusive means that, like I explained earlier, you can't have A and B happening at the same time, which means if you have A, then you don't have B. If you have B, then you don't have A. And then it must be collectively exhaustive, which means every scenario must be covered in your hypothesis. It must be covered in your hypothesis. So I can say, oh, I am 10 years old. If I am 10 years old, what covers everything else would be that I am not 10 years old, which means if I'm 30 years old, it's covered. If I'm 5 years old, it's covered. If I'm 90 years old, it's covered, right? And so that will be collectively exhaustive. That every scenario must be accounted for in your hypothesis. And always remember that your null hypothesis does not take an not equal sign. So you cannot structure your null hypothesis as not equal to. Why? Your null hypothesis is actually what you're trying to disprove. Your null hypothesis is until you find evidence against it. Therefore, it cannot be not. So it is unless you find evidence against it. That's why it cannot take. It can take greater than, it can take less than, it can take less than equal to, greater than equal to, but it cannot take not equal to. Now, these are some of the test statistics that you might face, and what just to bear in mind. Test of a single mean. In hypothesis testing, you could test that a particular hypothesized mean is different from 0 or a particular number. And typically for hypothesis testing, you would do what we call calculate the test statistics, and then you compare it with other parameter measures, right? And then you make a decision on the basis of that. There are 3 ways in which you make that decision. You could use what we call the critical value. When you're using the critical value, it means you will compare your calculated T to your critical value. If you're using p-value, which is the second option, it means you're comparing it to your level of significance. So if you have a p-value of 4%, then you should be comparing that to your level of significance of 5%, right? And then confidence interval is compared with your hypothesized mean. Those are the 3 ways. How do you treat p-value? P-value is the lowest, lowest, LOS at which you can reject. Now, what does that mean to be say lowest? Lowest means that you're coming from above, right? And what that means is if you're coming from above, everything above is rejected up onto your p-value. So if you have a p-value of 4 and your LOS is 5, because you compare your p-value to your LOS, right? It means your p-value automatically is in the reject zone. Why? Because you're coming from top. And for you to get to 4, you will cross 5. And everything up until your 4 is in the reject zone because it is the minimum. Remember, if it's minimum, it means it's coming from a higher level to a lower level. Therefore, when you have an LOS that is above your p-value, it is clearly in the reject zone. So that is how you look at your LOS compared to your p-value in making a decision. Non-parametric test. We talked about parametric test. Parametric test is test that uses mean on variance. But non-parametric tests are tests that do not use, they do not concern mean or variance. Those are non-parametric tests. And there are 4 situations in which we can use that. When data do not meet distributional assumptions. Distributional assumption is normality that we talked about for central limit theorem, for example, or log normal, as we've talked about. So if your data does not meet that distribution assumption, then clearly you cannot use parametric test. When you have outliers, we talked about the impact of outliers, you also cannot. When your data is given in ranks or in ordinal scales, first, second, third, you cannot use parametric because you cannot say the average of first and second or the average of fifth and tenth. Really, it's not nonsensical, and so you can't use that. And then when the hypothesis does not concern parameter, if it concerns parameter, it means it concerns mean, it concerns variance. When your hypothesis is on correlation, correlation is not a parameter. So those are some of the non-parametric tests, and these are some of the equivalent non-parametric tests that you could do for a parametric counterpart. Simple regression. Let me see if I can cover this simple regression in the next few minutes. Simple regression. For simple regression, you want to understand your dependent and independent variable. Your dependent variable is a variable that depends on another variable to be defined or to get its value, right? Independent variable is a variable that is used to define the variable of another variable. So in this model specification, your y is your dependent variable because it's depending on x, and x is your independent variable because it's not depending on anything. Your BO is the intercept. And what is the intercept? Your intercept is the value you get if your independent variable is 0. For example, if you do not earn a salary in a month, there are bills you will still pay, right? Now, if you do earn a salary, maybe you would then go out, you eat shawarma, you do all sort of those things. Those are variable, right? But even if you do not earn a salary, you will still pay bills. That will be your BO. That will be your intercept. The slope coefficient is the responsiveness of your independent variable to your dependent variable, how responsive it is, right? And we'll see that. Linear regression assumes a linear relationship between the dependent and independent variable. So it is assumed that there is a linear relationship between this independent and independent variable. That's what simple regression assumes. That's a simple regression, right? Simple regression assumes, the reason why it's called simple regression is that you only have one independent variable. Or as against when you have multiple regression, where you have multiple variables when you go at an advanced stage. The goal is to fit the line to the observation to minimize the squared deviation. So the deviation we talked about earlier, you want to minimize it, which means when you have observation, you want to fit a line across so that when you look at the deviation from that line, it is minimized. The line that minimizes is called the line of best fit, which is your simple regression line. And these are just the formulas to calculate your B, that is your slope and the intercept. Yeah, from a calculation point of view. This is still just presenting it from a calculation point of view, understanding, how to get from, if you have a table, how to calculate your B1 and your BO from that table. If you get a table like this, it should be pretty easy, to get it. Just calculate your variance, calculate your covariance, and then find it. Remember that your B1 is your covariance of X and Y over the variance of X. You will notice that B1 is very close to another formula, which is your correlation, right? Which is your correlation. If you have one independent variable, your B1 and your correlation is actually very close. How do you interpret regression coefficient? This is very important. Suppose that if the slope is positive, let's say the slope is 1.2, right? It means that if portfolio A goes up by 1 million, then portfolio B will go up by 1.2 million. If portfolio A goes down by 1 million, portfolio B will go down by 1.2. Now, if you link this to what I said earlier, positive correlation means they are going in the same direction. So you will see that they are both either going up or going down. The 1.2 just simply says that the rate at which one is going down is higher than the other one. if this 1.2 is 0.8, it means that the other portfolio will go down lesser than the first portfolio. If the slope is negative 1.2, it means that as one is going up, the other one is going in the opposite direction. And that is important in interpreting it. I will just end it with the assumptions of linear regression. We have 4 of them. Now, linearity means that there is a linear relationship between your x and y. We talked about simple regression. I would say it's a measure of linear relationship. So there is a linear relationship between your x and y. The remaining 3, 4, and 5 actually speaks to the variance. When we say homoscedasticity, homoscedasticity means that the variance of the regression residua is same. The assumption or the expectation is that is the same. Now, you do not expect variance that are not the same across all observation. Yes, it might not eventually end up being the same, but the assumption is that they are the same, right? And then now, what that simply also means is if I stand in the middle of a football court and I'm throwing a ball, I'm most likely going to have a variance that is slightly knitted. My expectation is that I will have a variance that is the same. That is, the distance I will throw the ball to should be exactly the same because I'm standing at a particular point. But if I assume that that is not the case, it means I'm not standing at a particular one point. It means that my center has moved. Independence means that my variable does not affect my my residual, which that is my variable is uncorrelated with my residual. And a good example of that is I'll just round up here. I can see that it's 3 o'clock, but let me just finish this slides. This particular slide. Apologies. Now imagine you put you want to look at the striker that can score the most goals, right? The most goals scored by a striker that can be scored by a striker, and then you put me and Ronaldo, the Ronaldo that you know, right? And you put us in the pitch. If I kick 10 balls and score say 2, and then Ronaldo kicks 10 balls and scores 8, you're not measuring the same thing, which means who you put on the pitch determines your outcome. If you put Ronaldo on the field, you get better outcome. If you put me on the field, you get lower outcome. What that means that the residual is correlated to the person you put on the field. My residual, my error, my deviation from actual is going to be correlated to me. And that's what independence means. Your residual should not be correlated to your observation. And normality means that your residual, if plotted like your distribution or your sample distribution, should be normal. Because that is the basis for which we can actually use those values, really. My time is up, and I think I'm just going to stop here and hand over back to Gloria. Thank you.
Thank you very much, Williams. Really appreciate your time. So the next class and the last one for today is derivatives, and that'll be taken by Fola Abimbola. Fola is also a CFA charter holder and a member of CFA Society Nigeria. Thank you so much, Fola, for joining early. I've made you a co-host so you can unmute and share your screen as well.
Thanks, Gloria. Hi, everyone. Hope you're finding this sessions very useful. I'm a big believer of practice questions. Because when I was writing my CFA as well, I spent a lot of time practicing questions for all the courses. So what we'll do is we'll start with, I'll just give you like a brief rundown of the whole derivatives curriculum, and then we'll go and solve a number of questions. So let me just share my screen. And when I share just hold on, I'm going to share my screen now. Okay. Hold on. Just need to. Right. If anyone can confirm that you can see my screen right now, I really appreciate it.
Yes, I can.
Okay. Thanks. So like these are the LOSs here. A lot of it are just to test your understanding. The only calculate you see is maybe calculate the forward price, which is quite straightforward. But a lot of them are just explain, identify. So it's like a background to the derivatives, and they want to test your understanding that you actually understand what derivatives is. And so next slide, this is just an overview of, hold on. This is just an overview of the whole derivatives market. We have forward commitments and contingent claims. Forward commitments divided into forward contracts, and they are called forward commitments because they are commitments. You don't have an obligation here. You have an obligation here to do certain things as stated in the contract. Now, forward contracts and futures contracts are similar because one is traded on an exchange, but one is traded on an exchange, the other one is an OTC. Swaps are OTC. So basically, this is just a high level overview. And I'm sure you guys now understand all this after reading the curriculum. I would like, for the sake of time, I would like to just jump into some of the questions that I want us to do together. So the first question is, so you have this person, how do you get this? You have this person sells 4,000 equity index contracts, 224 per contract. She's required to provide an initial margin of 20. We all know what an initial margin is. So when you are in a futures market and you want to buy a contract, you have to put something down called a margin, which is like a deposit. And you have two types of margins. You have the initial margin and maintenance margin. Your initial margin here is your 20 euros. Maintenance margin, 12 euros. So when her margin falls below maintenance margin level of 12 euros, what happens? She has to meet margin calls. Now, in the event of a margin call, the exchange requires additional margin to be contributed up to the maintenance margin level. So now here's the tricky part. In the curriculum, and in common practice, when you have a margin call, you need to bring your margin level back to your initial margin. So that's the practice, that's the standard practice. So in practice, it should be 20 euros. But now that's why we need to be reading the questions carefully. It says that the exchange requires margin to be contributed up to the maintenance margin level. So now that is the part where, so that's the key part, and a lot of people could make mistakes on that. Hold on, let me just get my writing tools. Okay. Gloria, do you know how to, like, I can't, this Zoom seems quite new. How do I get the annotation tools? Like, if I want to start writing, I
So
can't find that marker. Sorry. Where is it? Where is it?
I think normally if you click on that more button, hold on.
Okay,
Mm.
let me try that.
So what I see there is a whiteboard. Mm, I don't see that option.
That's fine. That's fine. I'll look for it. So just yeah, this Zoom seems new. Hold on, apps. Where is it? This is taking so much time. No, not this one. This one, not this one. Okay. I don't. Okay, yeah, I think it's here. No.
I'm checking. I don't seem to
Yeah,
see
yeah.
that
So
option.
I got it. So thanks, Gloria. So now you have day one. Day one. Sorry about my writing. It's not that good. Um, Now the beginning price was 224 and the closing price was 234. Now, Colin O'Farrell, this person is short the futures contract. Um, well, let me ask you guys, what do you think would happen in day one if the beginning price was 224 and the closing price was 234? Does she lose or does she gain? How much is this now? Does she gain 10? Is this 10? Yeah. Does she gain $10 or loses $10? Okay, so she loses $10. Now, so what happens is her margin, because what the question asks is asking, the question is, oh, jeez. Okay, annotate. Get this out this way. The question is asking what would be her the balance in her contract on day three. So day one, she loses $10, as we all agree. Her maintenance margin becomes 20 minus 10. Then her maintenance margin becomes $10. It says she has to bring her margin back to $12, which is the maintenance margin. So what she does is she gets a margin call. Now she brings in how much? $2. Now her maintenance margin is back to $12. That's day one. 12 euros, sorry. Now day two, this is day one. Day two, the price also goes up. So it goes up by 14. So 234 to 248, it goes up by 14 euros. What happens? Her margin falls to 12 minus 14 equals to minus 2. So how much is she required to bring back in this case on day two? How much is she required to contribute back to bring her maintenance margin? 14. So she brings back 14. So she contributes plus 14, and it brings her maintenance margin back to 12. That's day two. Now, day three, what happens? It favors her because the price falls by $18. So what happens? She has 12 plus 18. That will be equals to 30. So on day three, the contract or the balance in Colin's margin account is 30 euros per contract. And it says we have 4,000 contracts. So that's 30 times 4,000. So that gives us 120,000. So C is the answer here. Okay, now let's go to the next slide. Let me clean this. Okay. Now, the next one talks about which of the following is least correct? A credit default swap is a what? What do we think the answer is here? A credit default swap is a, people are saying C. Is it though? Is it C though? Is it B though? So let's go back to this. A credit default swap. Look at this. Sorry. Can't stand this. Just need to get rid of. There's no way you can just clear all these things at once. Okay, so look at this. So we have credit derivatives and different types of credit derivatives. You have one of them is credit default swap. So unless I didn't read the question well, let me see. Hold on, let me go back to the question. Oh, which of the following is least correct? Sorry. A credit default swap is, so this is, it's actually, a credit default swap is a credit derivative. It is what's the word? Sorry, my memory. Yeah, it is a contingent claim. So C should be the answer. So those of you that said C, you were actually correct. And I guess I fell for this trap also because I didn't read the question. So I just, and that's why we need to practice as much, because practicing helps you to kind of understand what the question is asking. Because a lot of people, even if you knew it, you would have just lost a mark because you didn't read the question very well. Now, next one. Which of the following is the least likely reason for an arbitrage opportunity? We all know what an arbitrage is. Arbitrage is like a riskless profit, and a lot of people use it in the derivatives market. What do we think the answer is for 1 or 2 here? The least likely reason. C. Someone says C. Yeah, so C is the answer because significant to remain unexploited. So significant transaction cost, difficulty entering short positions. All these are reasons why people would sorry, these are not reasons why, but ethical objections to taking advantage of mispricings, meaning there's nothing unethical about undertaking arbitrage. In fact, you're even doing a market a favor by bringing prices back to equilibrium and taking advantage of those mispricings. Next question here. So this is a little bit of calculation here. Sorry, let me see. I think there's a Q&A. So okay, get this out of the way. Okay, so the next question here is, how do I annotate again? Okay, so you have a company has a $4 million debt, 3-year debt, pays fixed rates of 7.6%. So rates 7.6%, as it is expecting interest rates to drop over the coming, sorry, let me get this out of the way. It really annoys me. Okay, so it gets so the notional value of the swap contract is 40 million based on 360-day LIBOR. If on 360 is if LIBOR is 1.3%, which of the following statements is least correct? So let's do a deep dive into what the question is really asking us. So look at here. It says it expects rates to drop significantly and it enters into a swap contract with a fixed leg of 4%. So if you expect interest rates to drop significantly and you enter a swap, would you be a fixed rate payer, or would you be a fixed rate? So would you want to be receiving the fixed rate, or would you want to be paying out the fixed rate if you expect interest rates to drop? I'm sure we all know what a swap is. So let me see if, so what do we think? Do we expect this company to be the fixed rate payer or the fixed rate receiver? Yes. So you'll be the fixed floating rate payer, and you would receive fixed rates. So think about it. You expect interest rates to drop. So let's assume interest rates, your fixed rate agreement, the rate there is, your forward rate is 4%. Now, interest rates drop to, let's say, 1%, just for argument's sake. You would want to be receiving, because you expect interest rates to fall, you would want to be receiving this 4%. So now, what they're saying is, if LIBOR on day 360 falls to 1.3% per annum, we all know that the floating segment of the agreement is 1.3% plus, sorry, 1.8 plus LIBOR. Now, what happens? The floating rate payment that this person is going to be paying would be 1.8 plus 1.3%. That should be equal to 3%, 3.1%. So now, how do we answer what the question is really asking us? What we are going to do is, we would say this person receives 4%. Now this person pays, you are paying out, so we minus what you're paying out, 3.1%, right? Now the convention is a 90 to 360 day convention. So that's because it's a 90-day LIBOR. So we have to, so this is 90 divided by 360. Now, we now say, what is the size of the debt? Because the notional value of the swap is this. So this is 40 million, right? I hope you understand this. So what I'm saying here is that this first part of the question, which is relevant, but it's not really helpful to us in the context of the question. They are saying that which of the following is least correct? The 90-day LIBOR rate on day 360 corresponds with what? A swap payment of, so they've given us the options. For us to even know what we are supposed to answer here, whether it's A, B, or C, we have to know whether this person is going to be gaining or losing based on the interest rate that fell, the floating leg that fell. Now, I said this person received 4%. This is what you will be receiving because you expected interest rates to fall. So you entered a swap contract in which you were receiving the fixed leg. So you are receiving the fixed leg, you are paying out the floating part. So this is the floating part. So this is fixed. This is floating. Now, you are paying this out. You have to bring this back to the pre. So you have to bring the 90 to 360 day convention here, which is 90 divided by 360. And then you multiply it by the notional value of the swap contract. Now, when you do this, you should have 90,000. Now, let's go back to the question. now we know what the question, we know what this person is going to gain. But now we have to understand what the question is asking. Which of the following statements is least correct? The 90-day on day 360 corresponds with a swap payment of 690, which is false. Sorry. Which of the following is least correct? Least correct. So this is sorry, just a second. I'm confused here myself. Least correct will be made on day 450 will be made to. So yeah, so I think so in this case, this is not correct. So this should be the answer. Will be made on day 50, day 450. So the way swap contracts work is that you don't pay the swap. So we're looking at the we're calculating it on where is it? On day 360. So today we are calculating it here. We are on day 360 here. But after we do the calculation, the payment is not made at that day. The payment is made because it's a 90-day swap, because it's every 90 days that the exchange is done. What happens? The payment is not done on day 360. The payment is done on day 360 plus 90. So the payment is done on day 450, right? So this is actually correct, which is wrong for this question's sake. Now, the payment is made to company XYZ. So what happens? 90,000 is made to XYZ. So where's my eraser? Let me not confuse you guys. So sorry. This is wrong because it is correct. This is wrong because it's also correct, because they're asking which of the following is least correct. So 104 should be A, because the payment that is made is not 690, is 90,000. Okay. Takes a lot of time cleaning this. I wish there was like a shortcut that allowed you to just clean everything. Anyway, so let's go to the next. An investor is considering purchasing 1-year call options in Dalanium. Dalanium is a kind of metal which is currently trading at 566.2 per ounce. The price of Dalanium after 1 year will be either 20% up or 10% down, and the only available call option has a strike price of $600 per ounce. If the risk-free rate is 3.2%, what's the value of the call option? Now, this is, I'm sure a lot of us saw it in the curriculum. It's binomial. I think it's binomial options. So you have different ways of valuing an option. There is the Black-Scholes model, which you would see a lot of in level 2 and 3. And then there's a binomial. This, from an exam perspective, I doubt that you'll be asked to give calculations based on binomial options. But let's still do this. And it was talked about in level 1, but you see it in more detail in level 2. But let's just quickly solve this question. So now we have, so for this one, we have to have two things. We have a U factor. So our U factor is in this case is equal to 1.2. That's our U factor is 1.2, or or you can also say our U factor is 120%. Why is that? Because the value of a stock goes up by 20. Or let me not confuse anybody. Let's just say the U factor is 1.2. Our down factor in this case is what? Is 0.9. So I hope you guys are so to calculate the U factor, all you just do is just say 100% plus 20%. That will be equals to 120%, right? Which is equal to 1.2, which you can also call 1.2. And our down factor is 100% minus 10%, which is equal to 90%, which is equal to 0.9. Right, so we have our U factors and our D factors. Now, what they're saying is the price of palladium after 1 year will be either up 20% or down 10%. So now we have to get the prices of this item when it is up 10%, when it is up 20% and down 20%. When it's up 20% and down 10%. So our S plus will be equal to 566.2, right? Multiplied by 1.2. So what do we have? We get 679.44. So when the price goes down by 10%, if the price goes down by 10%, we have 566.2 times 0.9. Now that gives us 509.58. Right, so that's the 2 now. We have the price if it goes up and it goes down. Now, the value, we all know that the value of a call option is the maximum of ST minus X. The price of the underlying, ST being the price of the underlying, and 0. ST being the price of the underlying, and X being the price of the option. The strike price, not the price of the option. Now, in this case, the value of the call when we have S plus, when the price of the aluminium goes to 679.44 is equal to maximum of 679.44 minus 600 or 0, right? So that will give us 79.44. Our C minus will be 0 here because we have maximum of, what's our S minus? 509.58 minus 600 and 0. So what's the maximum here? The maximum here is 0. So we have our C plus and we have our C minus. Now we need to calculate something else. It's called the risk neutral probability. And there's a literature that, explains it in the curriculum and all. But it is what it is, and it's denoted by this pi. Now to find this pi, sorry, I have to clean up all this. I have to clean everything. To find this pi, we have 1 plus our risk-free rate minus the down factor all over the up factor minus the down factor, right? So we then have, so our pi is 1 plus, what's our risk-free rate? Risk-free rate is 3.2%, 1 plus 0.032 minus 0.9, which is our down factor. We already calculated that. Now, divided by 1.2 minus 0.9. Now, this should give you 0.44. So guess what? We have our C plus. So the price of the option when the price goes up by 20%. We have our C minus, which is 0, which is the price of the option, the value of the option when the price goes down by 10%. We also have our pi. Now, what do we do? To get the value of the option, we say our pi into C plus plus 1 minus pi into C minus divided by 1 plus R. So that then we then have, so we then say that 0.44 multiplied by, what is our C minus? Our C minus here is 79.44. Sorry, yes, and then plus 1 minus 0.44. Our C minus is 0 here, so this will become 0, divided by 1.032, which is our 1 plus R here. So 1 plus 0.032, right? Now, when we calculate this, we should have 33.87. 33.87 is here. Thanks, Gloria. Let me try that. Oh, awesome. Oh, thanks. That's very relieving. Okay, so next question. Okay, so this is another set of questions. We have 20 minutes left. In comparison to the underlying spot markets, derivative markets tends to be what? What do we think the answer to 98 is? Anyone? C, great. So derivatives tend to be less liquid. No, they're actually more liquid. Entail higher transaction costs. No, they actually entail smaller transaction costs. They offer easier access to leverage and short positions. Yes. So this question, I don't think I want to spend much time on it because this is probably level 2 material. I'm not sure why this was included in it. So I'm going to skip it. Now, this question, BWC, I think this is swaps, right? Swaps. Okay, so BWC is the fixed rate payer on plain vanilla interest swaps. Since swap commencement, interest rates have fallen considerably. Which of the following is most accurate? So for questions that relate to swaps, I think even if you get anything that has to do with calculation, it will be very basic because all they are doing is testing your understanding of your of the foundations of derivatives. So these are probably the kind of questions you will get. So for swaps, you need to understand, especially interest rate swaps, plain vanilla ones. You need to understand, like, if somebody would want to be the fixed rate payer or the floating rate payer based on the anticipated movement of interest rates. So what they are saying here is this person is a fixed rate payer. So we already know that this person pays fixed rate and receives floating rates. Since swaps commenced, interest rates have fallen considerably. So in this case, I need to ask you guys a question. Interest rates have fallen considerably. What happens? Is BWC losing here, or is BWC going to gain here? Because BWC is a fixed rate payer, but interest rates are falling considerably. What do we think? We'll lose. Thank you, Francis. So BWC would, okay, thanks, Cynthia Osario. Okay, yes, they will lose. Thanks. Now, the question is asking which of the following is most accurate? The swap will be an asset for BWC. It won't be an asset because an asset is when you are gaining. The swap fixed rate will have fallen. The fixed rate never falls. The fixed rate is constant throughout the contract. The present value of floating rate payments will be lower than the present value of fixed rate payments, just like we said. So the present value of the floating rate payments here, because this person is the floating rate, the floating rate receiver, the present value payment will be lower here. So C is the answer. Excuse me. The price of an underlying security is $5.20. A put option with an exercise price of 5.28 has a premium of 0.08. The put option is currently trading what? What do you think the answer for 101 is? Please explain this concept. Rabbi, what concept do you want me to re-explain? Thanks. 101 in the money. Yeah, so you have where's my annotation? So you have the value of a put option is equal to maximum of 0 into x minus st. And in this case, the exercise price is higher than, so x is greater than st. And for a put, when the exercise price is higher than the price of the underlying, the put is in the money. So A is the answer here. Okay, so in the money, out the money, and at the money. I need to know more about them. Honestly, you don't need to stress yourself to try and, like, what's the word now? You don't need to overstress yourself with in the money, at the money, and out of the money concepts. Just remember that for a call, what happens? You want your strike price. If you buy a call, you want your strike price to be greater than you want the price of the underlying to be greater than the strike price. And when the price of the underlying is greater than the strike price, you are in the money. When the price of the underlying is equal to your strike price, you are at the money. You are at the money. When your price of the underlying is lower than the strike price, you are out of the money. And then for put is the opposite way around. So for put is the other way around. So that's just what you need to know. And when you are talking about in the money, at the money, you ignore this. Sorry. You ignore this one here. You ignore this premium. The premium is not relevant here. You are just looking at whether it's in the money or at the money. If you want to calculate the profit, that's when you now start, or loss. That is when you talk about premium. Premium has no relevance here. Let me see. So let me. Which of the following statements is most accurate? The lowest value of a European put is the greater of. What do we think the answer is here? Before I explain it, for those who don't understand it. But what do we think the answer is here? Okay, a lot of people are saying C. So let's look at this. Now this is where, for those of you that said C, this is where we need to understand the question. It says, it doesn't say, this annotate thing is, sorry, hold on. Yeah, it doesn't say what is the value. It doesn't say what is the value of a European put option. It says what is the lowest value. And if we read the curriculum, and you can go back to the curriculum to look at this, the lowest value, not the value, the lowest value of an option, put or call. Well, in this case, we are looking at sorry, hold on. Excuse me, guys. Sorry, 1 second. Rose- Right, guys. So I apologize. I think I made a mistake. I think you guys were right. I was wrong. So C is the answer because I didn't look at the options very well. The lowest value of an option is maximum of 0 and the present value, sorry, and the present value of the exercise price less the underlying spot price. So C is the answer here. I apologize for that. Um, Someone said basically put the formula. Yeah, so C is the answer. Sorry about that. A is not the answer. B is not the answer. It's C. Okay. Now let's go to the next question. Early exercise of an American option immediately before dividend would most likely be warranted for so they've given us different options for a stock call option. So let's look at it. If it's a stock call option, why would you want to exercise early before dividends? So what happens? When you exercise a call option, you've already paid the premium for it. You are buying the underlying. What does that mean? It means you now own the underlying. Guess what? You can then earn a dividend. So this is likely the answer, but I've not seen the other questions, the other options. Before a dividend, you get the underlying, you own it now. Now you get your dividend. So that's a rational reason why you would want to exercise. When carry costs are significant, carry costs are associated with you holding the underlying. So you would not want to start exercising your options and holding the underlying when you are going to incur cost of holding the underlying. So this is not the reason for a put option well in the money. When you exercise a put option, you are selling. A put is option to sell. When you sell, you don't own the underlying, meaning you miss out on this dividend. So the rational reason for exercising early of an American option is because of dividend, before dividend. So A is the answer here. Okay. A few more questions before we go. So 89, the value of a forward contract at expiration is the value of the asset. What do we think the answer here is? B, C. So let's think about it. Unless I'm not reading the question and the options very well, like I was doing before. The value of a forward contract at expiration is the value of the asset plus the forward price. So A is out of the question. A is not the answer. Minus the forward price. So it's either B or C. Now remember, this question is asking us. The question is asking us something. At expiration. At expiration, you don't need to do any discounting again because you are, how do I explain it now? You are on that day. So B should be the answer. That's because it is at expiration. You don't need to discount the forward price anymore because you are at that day. So let me just, so you have the value of the contract is S minus, now you're saying T minus T here, right? Now imagine it's a 9 month, it's a 1 year contract. In this case, you have 1 minus 1, it becomes 0. Now this becomes, so this is no longer there again. So on the day of expiration, what do you have? You have the price of the underlying minus the forward price. So B should be the answer. So let's this contract at expiration is what changed the whole concept here. That's what altered the whole thing here. Let's look at the next question. Right. A put option is selling for $6, for which the exercise price is 72 and the price on the underlying is 77. The maximum profit to the buyer and the break-even price at expiration is what? Now, this can be very tricky, so let's look at it together. Now, what did they say? They're saying that the put is this. So you have the amount you paid for the put is $6. Your exercise price is $72. Our S is $77. So we have 77, 72. So this is X here. X is 72. Now what happens? We have our price is now at 77, right? we paid $6. Now, for us to actually be in the money, we have to, no, not in the money. For us to be in the money, actually, our price, so our S, has to be below 72. Now, for us to even make a profit, our S, our price, has to be below 72 minus 6. I hope we get it. In the money is different from profit or loss. Now, for us to make a profit, the price has to fall below 72, right? So now, let's start with this break-even price. Our break-even price is the price at which our profit is 0, right? So our break-even price should be 72 minus a certain price level minus 6, which is the price of the premium of the option, the premium we paid, is equal to 0. So we have to find what this price would be. So our price here would be 66. So our break-even price at expiration should be 66. Now that's this one here. If you don't want to go further, because this is the only one that has 66, you can say, okay, this is the only one that has 66. For sake of time, let's just pick. I'm just going to pick A. But now, let me just explain this maximum profit to the buyer. The maximum profit you can make as somebody who owns a put is if, let me erase this. If the price falls, so this is the price, this is where the price is. If the price falls to 0, your maximum profit is what? This 72, guess what? Guess what happens? Let's assume the price falls to 0 and you exercise your put option. You can only sell at this $72 strike price. So your maximum profit would be 72, but then you have to factor in how much you paid for the option. 72 minus 6, which is 66. So I hope I was clear in explaining it, because it tends to be confusing for a lot of people. Right? So what we said, we calculated the break even. We calculated the break even price, which is we are equating the cost of, we are saying that the price should be at a point where when we take out our S and we take out the price of the premium we paid, it should be 0. So that's how we got our 66. Now, the maximum price here is this. When you exercise your put option, you would, so they're saying what is the maximum? You would receive $72. No matter what the price falls to, you would receive $72. Now, your maximum profit here would be when the price falls to 0, because this is not the maximum profit. If it falls to 70, it's not the maximum profit. If it falls to 50, not the maximum. Your maximum profit here is when the price falls to 0, because the price cannot go below 0. What then happens? You then say, okay, our 72, we then have to factor in the cost of acquiring this option, which is why our maximum profit, the price at which it is 66. Okay. Our next, I think I'll just take one more question because I know we're out of time now. So what is the highest value? Vivian, what question are you talking about? I'm not sure which of the questions you mean. Sorry, I wasn't looking at the Q&A. I was only looking at the chat. Anyway, let me just go to the last question for the sake of time. Derivative price least likely depends on what? What does it least likely depend on? What do we think 91 is? $91? Anyone? Any takers? 91, B. Thank you. So derivatives assume risk neutrality, meaning that if you're looking at corporate finance and equities and the other courses, a lot of them use, when they are discounting, a lot of them use a risk rate that takes account of risk aversion. But in derivatives, you use risk-free rate to discount. And that's because it is assumed that you have used your derivatives to mitigate or limit your risk. So risk neutrality is a key assumption for derivatives. So you don't really talk about risk aversion with derivatives. It assumes risk neutrality. So B is the answer because B is least likely. The question about the max price, max price is not always break-even point. It depends on if it's a put or it's a call. But it's not always the case. You will have to take each question in isolation to know whether it will always be or not. But for that question, this is the answer. A is the answer. So Vivian is saying the question about the lowest value of a put. The highest value of a put is going to be, and we've proven it. We've proven it that the highest value of a put is the amount that we receive when we exercise minus the cost of acquiring the puts. So that would be sorry, you said what's the maximum value of a put? The maximum, sorry about that. Let me just quickly answer this question from Vivian because I think it's important. The maximum value of a put is, I really don't know what that is. But all you know is the maximum value of a put depends. It depends on what our X and ST is. But you don't need to concern yourself knowing what the maximum value of a put is. You only need to know what the minimum value of a put is and what the value of a put is. That's the only thing you need to concern yourself with. So minimum value of a put, if they say what's the minimum value of the put, that is when you say X into 1 plus R, so the PV of X minus ST. If they ask you what is the value of a put, that's when you say max. That's when you say X minus ST. And of course, you need to have, in both cases, you need to have maximum of 0 and this in both cases. So maximum of 0 and X minus ST. Okay, guys, I see my time is up. What is PV of X? The PV of X is our X divided by 1 plus R. That's the present value. Right. Guys, I wish you all best of luck and have a enjoy the rest of your evening. Bye.
Thank you very much, Fola, and thank you everybody for joining this session yesterday and today. And I would just like to say apologies, we couldn't cover all the 10 topics as we always do because of availability of charter holders to facilitate the session. But just to compensate for that, the email you are going to receive shortly will carry a link to a playlist of the last bootcamp we had, that was August 2025. I believe the content is still relevant. I think we were able to cover all the topics, so you should be able to find revision classes for each of the topics that we've not covered. It's also going to contain, the email will also contain a link to a gallery of short video clips, ethics video clips that was shared by a facilitator who took ethics last time. I think that will be very helpful. And we'll also share slides from the facilitators who are able to share their slides with us. Thank you. We wish you all the best in your exams, and we look forward to you moving on to level 2 and joining the next level 2 revision bootcamp. And yes, I think that's all. Thank you so much to all our facilitators for really just giving your time, your talents, and your resources to make these sessions happen. We really appreciate. All the best, everyone, and good luck in your exams.
We are professionals. We are impact-driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynG.org for more details. CFA Society Nigeria, making finance